Hello, everybody, both in the room and online. Welcome to Nest Insight's 2023 Emergency Savings Summit. It's great to have so many people joining here in person. We know we've also got a really great number of people joining online, so that's fantastic. This is going to be a tiny bit of housekeeping from me before I hand over to the event proper. So the first thing to say is we really do want this to be an interactive event. Whether you're attending remotely or in person, you can put your questions to our speakers by using slido.com and entering the hashtag emergency savings. We'll also have, for those of you in the room, roving mics running around the room for you to ask your questions in person if you prefer. If you find you're having any issues with the stream, for those watching online, please email insight@Nest Corporation, and we will do everything that we can to help get that resolved. Today's session will also be made available as recording. So I think with that, all that is left for me to do, initially at least, is to hand over to our introductory speaker, who is Gavin Lewis from BlackRock. Some of you will know him as a managing director here at BlackRock. Others of you will now know him as the author of The Opportunity Index, a book which, if you haven't encountered it yet or had a chance to read it, I cannot recommend highly enough, and is deeply, deeply relevant for the kinds of issues that we're talking about today. So with that note, I will hand over to Gavin.
Great, thank you all, thank you, Will, and thank you for accepting the job as my publicist. I really appreciate it. Thank you all for attending and welcome. So thank you all for the introduction. I'm Gavin. I manage BlackRock's institutional clients business, which essentially are clients who are across public, DB and DC pension plans who invest with BlackRock. And it's great to have you all here today. Obviously, welcome to everyone in the room and those who are online. I hope I'm coming through loud and clear. And also thank you very much for taking time out of your busy schedules. We know these events are critical, but you all have competing agendas. So again, a huge thank you from us, given the importance of this topic. And today's conversation really is about what we can do as a group, as an industry, to improve the financial well-being of households and families across the UK. And it doesn't need any introduction from me to remind you all that this conversation couldn't be more important than right now, because we are living in some very, very difficult and challenging times. Last year, the Money and Pension Service reported that a quarter of all UK households don't have enough savings or even access to affordable borrowing to pay for an unexpected bill of £300 or more, which is stark. And this situation continues to be aggravated by the ongoing cost of living crisis and a somewhat gloomy macroeconomic backdrop and environment which we are all trying to navigate. So those £300, even if they could get access to it, simply don't go as far as they once would have. And yet they're needed more than ever. So given this urgency, I'm hopeful that today's conversation will not just highlight the magnitude of the challenge, but also provide actionable and applicable pathways to help most who need it. I will also say that I have a little bit of a personal issue with the term cost of living crisis, because it feels like it's been recently coined. And the reality is that for many people, they are in a perma cost of living crisis. The community that I grew up in, the community that I'm still part of, friends of mine, have been struggling for many, many years. It's just that this is now on the agenda because it's perhaps affecting a wider proportion of the population. We should use the fact that it is now on the agenda to create even more urgency around this issue, is my feeling. BlackRock's mission is to provide more and more people with financial well-being through long-term savings and investing. But as I said, we know that for many people, the future can be difficult, particularly when they face uncertainties right now. So whether that's a change in their employment circumstances, a rise in mortgage payments, or a sharp increase in food and energy bills as this cost of living rises. And that's why in 2019, our social impact team launched BlackRock's Emergency Saving Initiative to strengthen the economic resilience of individuals and families across the UK, but also the US, particularly those living on moderate income, low to moderate incomes, I should say. And through our Emergency Savings Initiative, we supported Nest Insights and other leading health organisations, financial health organisations, to trial innovative saving solutions that help households build a financial safety net that they can really rely on. And the programme is yielding some very positive results and providing vital insights into what employers, service providers, policymakers, and others can do to continue to strengthen the financial well-being of communities across the country and again in the US. So I think we're really encouraged by the progress that's been made to date and excited by the possibility of what else we can do. We're also very proud of this partnership, and it's a real privilege to share the ability to host today's event with JP Morgan Chase Foundation, so thank you, and the Money and Pension Service for co-funding Nest Insights Sidecar Savings Trial with BlackRock. I, and I'm sure you are all, looking very forward to the final results of that trial as part of the great agenda that we have ahead of us, which we'll run through this afternoon. So without further ado, I'd like to hand over to Jo Phillips. As most of you know, Jo leads Nest Insights Research and Innovation Practice and will take us through her team's latest publication on the Sidecar Savings Trial's final results. Jo, the mic is yours.
Thank you, Gavin, and good afternoon, everyone. I'm absolutely delighted to be here today with you. Together, you bring an absolute wealth of experience to what I hope is going to be a really collaborative and energetic debate amongst this growing community of people who are really committed to boosting saving. There is huge potential for workplace savings to support millions of UK households to be more secure, to be happier, and to be more productive. But there are also great challenges we need to address and some barriers we need to overcome if we're going to make this happen effectively at scale. That's why we've brought you all here together, and our objective today is to collaboratively make progress against that goal and to start to set out some clear steps for what needs to happen next. So to set us up, I'm going to take some time to share with you some highlights of what is now, we think, a really robust and compelling evidence base, built up through over 4 years of real-world trials in UK workplaces of different saving solutions that are all designed to help employees build up emergency savings through payroll. So, as many of you know, since 2019, Nest Insight has been trialling a sidecar savings tool called JARS. JARS was built for the trial by Salary Finance and is offered in 5 UK workplaces: BT, ITV, Step Change, Timpson and the University of Glasgow. A sidecar solution is a particular kind of payroll savings. It's a hybrid approach that brings together short-term and retirement saving through the same mechanism. Workers sign up to save regularly via payroll and they set a savings target. After that, each payroll, their savings go into their own instant access savings account. But when they reach that savings target and they've got that emergency savings buffer in place, any additional savings after that point are made into their workplace pension on top of their existing workplace pension contributions. The savings account provider is Yorkshire Building Society, and any additional pension contributions are made into the existing workplace pension, which means that there have been quite a variety of pension providers involved indirectly in the trial. Today marks the end of that sidecar savings trial, and we've published full findings in a final report, Workplace Sidecar Saving in Action, which is now available on the Nest Insight website. We've learnt a huge amount about the real-world application of the sidecar savings idea, and I can't share everything now, so please do take a look at the report for more detail. Building from those learnings from the sidecar trial, Nest Insight has more recently convened and launched a further programme of workplace savings trials, looking at different designs of payroll saving in the context of more employee populations and more sectors. Our trial with Suez Recycling and Recovery UK and credit union Transave explores an opt-out approach to payroll saving for new joiners to the company. In this model, new employees automatically start saving £40 a month unless they choose not to. If they want to start saving, they don't have to do anything. It's all done for them. Only people who don't want to save have to take action, and this trial's been running for over a year now. Most recently, we've been working with employee benefits provider WageStream and two of their employer clients, one of whom is Co-op, to trial another version of opt-out payroll savings for employees who sign up to WageStream. This one is a randomised control trial comparing the business-as-usual savings sign-up journey with an active choice approach where employees are asked, do you want to save, yes or no? And thirdly, an opt-out approach where employees start saving automatically if they don't say they don't want to save. Some case studies from these pilots and some supporting information for any employers looking to roll out something similar is available in our employer guides to getting employees started with saving. That was also published this week. These trials are unique and groundbreaking, not just in the UK, but globally. There's been significant international interest, including from the US, where evidence of this work has fed into the development of the Secure 2.0 Act last year. That act paves the way for the adoption of opt-out and sidecar approaches to workplace saving by US employers. Together, the trials cover over 100,000 UK employees, and in the sidecar trial alone, we've collected and analysed more than 60,000 administrative data points and over 70,000 survey responses. Analysing that real-world behavioural data allows us to see accurately what employees are actually doing with their money. This is a better approach than asking people to tell us what they do because we know we're unlikely to get an accurate picture of what's happening from self-reporting in surveys. And we've worked with an eminent team of academics from Harvard and Yale universities to do this. They first put forward the idea of sidecar savings, and it's been great to go on this learning journey together with these experts. Importantly, though, we've combined this administrative data along the way with qualitative research interviews and quantitative surveys to make sure that we can also understand impacts on subjective well-being, how people feel, what difference savings makes to individuals and households, to really get to the why and the context behind the what that we're seeing in the administrative data. This kind of innovative work requires creativity and tenacity, and Nest Insight is so grateful to all of our collaborators, many of whom are in the room today or joining us online, and without whom this work could not have happened. That's all the employers, providers and research organisations I've just mentioned, and also our funders. Without JP Morgan Chase's support at the start of this journey and subsequent support from the BlackRock Foundation and the Money and Pension Service, these trials would just not have been possible. So thank you all. So what's the problem we're trying to solve? Gavin's already introduced this so well. Savings rates are particularly bad in the UK, so the memorably named, perhaps only if you're a kind of early millennial like me, Resolution Foundation ISA Baby report into savings that was published earlier this year called out that the UK has a long-standing problem of low saving, particularly for those on low to middle incomes by international standards. So we're not doing great in this country when we compare ourselves with others. That lack of savings, particularly in low to moderate income households, matters because there's likely to be no buffer there to cope with an unexpected expense like a boiler or a car breaking down, or indeed an extraordinary rise in living costs like energy bills and food prices. So Gavin has already quoted perhaps one of the most quoted statistics in our field. 1 in 4, a quarter of adults in the UK, couldn't pay an unexpected bill of £300. So what does that mean? In these circumstances, without savings, the limited options people have can be harmful. They may have to cut back on essentials, widely reported with the shorthand choosing heating or eating. They may need to borrow from friends or family, which we know can be fraught and problematic for relationships, or perhaps sell possessions like that car they need to get to work. They may take on costly debt if they have access to it, which can lead to damaging debt spirals, or they may go into essential bill arrears. All of this impacts physical and mental health and people's performance. People with no savings are 3 times as likely to report very low levels of happiness. Around half of those not saving regularly report feeling anxious about money. And employers care about this because people who are worrying about money are not productive and may be absent. Recent CIPD research found that over a quarter of employees say that money worries affect their ability to do their job. We know that having an emergency savings buffer, some money put aside to cope with ups and downs in income and expenditure, can prevent people getting into problem debt, can protect retirement saving, can support improved health and well-being and boost productivity at work. It's fitting, therefore, that the Money and Pension Service Financial Wellbeing Strategy for the UK identifies saving as one of its 5 core pillars and sets a goal of 2 million more working-age people on low to moderate incomes saving regularly by 2030. But how do we achieve that goal? The first thing we've learned is that it's really not an attitude problem. We regularly ask people how important they think it is to save for an emergency. Consistently, through the pandemic, through the cost of living crisis, almost everyone says they think saving for emergencies is important. So each of the blue dots on this chart shows answers to this question from surveys conducted by Nest Insights through the kind of recent years. And you can see how consistently high up the scale the answers are. People think that saving is important and they want to save. So whilst education and financial literacy programs are important, the real problem here, we think, is one of constrained resources: money, time, energy, and also behavioural barriers. And one of our key learnings from our programme of work is just how difficult it is for people who are not saving already to get started with saving. To put this in context, not all employees need support with saving. National government surveys show that about 6 in 10 households already have some savings, so we're not looking to get workplace saving participation to 100%. Based on everything we've seen, we think that if we were to reach those who are not saving but want to save and could save, appropriate take-up of workplace savings should be in the region of roughly 20 to 50%, depending on the employee population in question. But participation in workplace savings schemes is stubbornly low, well below that level. We've spoken to many employers and providers, and although there's no official data on this, we know that it's rarely above 5%. When we look at the data from our sidecar trial, we can see that there's a real gap between intent and action. So out of every 100 employees eligible for JARS, 46 of them, nearly half, say they think JARS would help them, but just 1 follows through. It's a huge drop-off. So even where there is a good savings solution in place, the barriers to getting started with saving in the workplace are many when people have to sign up to saving. Particularly right now, when people are focused to getting to the end of the week, it's hard to focus even on the near-term future. Even where employers and providers are doing great work in communicating that people can save in their workplace, awareness is often low. When people do get around to signing up, even the best design user journey contains friction, and people drop out at every step. You know, something like asking how much do you want to save can cause people to drop out because of the cognitive load of thinking that through. People often lack the confidence that they could be a saver, particularly if they found it difficult to save in the past, and that may stop them putting themselves forward and starting to sign up. And boringly but fundamentally, inertia plays a powerful role. So even when we mean to do something, we just don't get around to doing it. So there are many barriers. But the good news is that we now know lots about how to overcome those barriers. In our opt-out trials, we've seen quite a dramatic increase in participation when we flip the default of the joining approach. For example, at Suez, when people have to actively sign up to save themselves, just over 1% of them have done so by month 4 of their employment. However, when people start automatically saving if they don't opt out, 48% of them are saving in month 4. We're seeing something very similar in the wage stream opt-out trial, and Sarah from Harvard, from the Harvard team, is going to share some really positive, hot-off-the-press results from that for the first time later on, as well as more detail on the Suez trial results. I just want us to pause and think about how important this finding is. It's kind of hard to convey what a change we see here, not least because results from trials are often presented as participation has doubled, which masks the fact that absolute participation is still low. So we might see participation has gone from 2 to 4%, for example. Here, we go from hardly anyone saving to almost half of workers saving, which is reassuringly in that region of what we think appropriate participation should be. And we've asked Suez employees who are eligible for this in particular. So around half of them said they already had money set aside as savings, and over 9 in 10 of those who said they had savings said that they had more than £250. So some of them are already okay, but we think we are reaching a lot of people who weren't already saving through this opt-out approach. And then we also know that once people get started with saving via payroll, it's a really powerful mechanism for building savings habits and supporting people to save persistently. Because the money comes out automatically every payday before people feel their take-home pay in their pocket, they consistently tell us that this is an easy way to save. we can see hardly anyone closes their JARS account, so 99% of JARS users still have an active account after 18 months, and 73% of them are saving at that point. Most people save regularly and consistently every month via payroll. This can have a really positive impact in the shorter term. So we've seen that people build up a meaningful savings buffer. The median JARS savings balance at 12 months after opening the account is approaching £400. And we also see that people use their savings when they need them, whether that's to deal with an emergency cost, to pay for a more expensive month, to cover a period with less income, or just because they've reached a savings goal, like paying for Christmas or a school trip. 6 in 10 JARS users make at least one withdrawal in their first year, and some withdraw money more frequently. To be clear, we see this withdrawal behaviour as a measure of success. The point of emergency savings is that they're used when they're needed to prevent some of those more harmful outcomes I talked about earlier. We also see that people are using JARS and using payroll savings in different ways. So we see people using it to build a safety net, the use case we imagined, building up savings to cope with an emergency. There are some really powerful examples of safety nets alongside the kind of oft-quoted boiler. So we've seen coming through in some of our data that some people are using their JARS savings account, people who are victims of economic abuse, as a kind of hidden escape fund, for example. There are some really interesting and important examples of what a safety net means. We also see that people use payroll saving as a way of budgeting and cash flow management, of putting some money aside to deal with lumpy bills, perhaps quarterly service charge bill, or moments where you have to pay for a school trip all of a sudden. And we see people using payroll saving to work towards future goals, which could be shorter term things like saving for the summer holidays, or it could be longer term, like saving for a house deposit to move out of home. All of this together gives people peace of mind. It reduces anxiety and stress. We'll hear some more from some workplace savers in a moment in a short film, but this quotation from a JARS user really brings it to life for me. They say, "It reassured me. It put my mind at ease. It was stress-free." Excitingly, now we have the full period of the sidecar trial, we can also share for the first time the positive impact that this kind of approach can have on longer-term savings. So at 18 months after opening their account, a small but growing proportion of JARS users have reached their savings target and are making additional pension contributions. So 4% have extra savings going to their pension, and the median pension contribution via JARS is £100. There's some variation by employer here. So in 2 of our 5 employee populations, we see a higher proportion of savers, around 1 in 10, making pension contributions at 18 months. A few reflections on this. First of all, additional voluntary pension contributions are rarely made by employees who have been brought into pension saving under auto-enrolment. For example, only 1.5% of Nest members have ever made an additional direct contribution to their pension pot. Therefore, we believe that this level of additional pension contribution behaviour that we're seeing through JARS is encouraging. Indeed, this kind of approach could be a really good way to raise awareness that saving more into a pension is indeed possible. So Nest Insight recently did some work with Invesco that suggests that quite a high proportion of employed adults, 2 in 5, don't know that they can choose how much to save into their pensions. And another 1 in 3 think that the minimum contribution levels are actually levels recommended by the government of how much they should be saving. JARS, by having this pension rollover feature, has raised awareness that people can make additional pension contributions. And indeed, we know that some people signed up to Save with JARS just because they saw it as an easy way of making pension contributions on top of their regular contributions. And because that rollover happens only when the JARS user's savings account balance has met their savings target, and the user can change that target at any time, this sidecar design functions as a pre-commitment device to save more in my pension, but one that is responsive to changing financial resilience and financial well-being. You only make those additional pension contributions once you've got a saving buffer in place. But even without that rollover design, even with a sort of more standard payroll saving model, we know that emergency savings can effectively protect retirement savings. Having and using those emergency savings can make households more financially secure, and we know that that means that they're more likely to be able to save for retirement, both in terms of not opting out when they're automatically enrolled, not ceasing contributions further down the line, and also by being more likely to be able to save more than the minimum amount. And if people reach retirement in a position of financial security, their retirement savings will go further than if they reached retirement with high levels of debt or other financial precarity. And people who have a savings buffer in place are less likely to access their retirement saving early to cope with immediate challenges, which can deplete resources for retirement. In the UK, that can only happen at the moment after age 55, but that's still a long way before a lot of people plan to retire. There were some fears when we launched the opt-out trial at Suez that emergency savings would in some way cannibalise retirement saving and that we would see higher levels of opt-out from the workplace pension when it was implemented. This has not been the case. Suez has been able to maintain retirement saving levels whilst also significantly boosting shorter-term saving amongst their employees. A last learning I want to draw attention to is that the workplace is a powerful route for financial inclusion for those workers who are employed. We obviously need to continue to think beyond this route for those who are self-employed or not in work. But for those who are employed, we've seen that JARS savers are most likely to be those who were struggling with bills and commitments and those who are classed as squeezed by the Money and Pension Service. People save via the workplace who have never been able to save before or who have previously not managed to build a savings habit. People save by the workplace who are mistrustful of financial services providers. So we can see here, I trusted my employer. I find it very hard to trust banks as I don't know a lot about them, so it was good to go with my employer. And we think the opt-out approach is more inclusive still, as was the case with pension auto-enrolment, which brought many people previously excluded into pension saving. It overcomes barriers of confidence, of literacy, of accessibility. So a sidecar savings approach in combination with an opt-out joining mechanism has great potential to tackle two of the greatest financial challenges for low to moderate income households in the UK. Firstly, not having that buffer to cope with a financial shock today, and secondly, not saving enough to achieve a livable, dignified income in retirement tomorrow. It's effective, inclusive, and it can boost employee productivity. We all feel really positive about this. We had a great session last year at the first Nest Insight Emergency Savings Summit. There were lots of enthusiasts in the room. Some of you are here again today. And that enthusiasm was brilliant and it was quite infectious. But our reflection, if we're honest, on that previous summit was that the conversation was in danger of actually being almost too positive, of skirting over the very real challenges that remain if we are to meet the ambitious goal of 2 million more savers having the financial security that an emergency savings buffer can provide. We now have even more evidence than we had a year ago, in particular on the longer-term financial wellbeing impacts of saving in this way, the positive impacts of sidecar saving on retirement saving, and the impact that an opt-out approach can have. But we've also learned a lot more that suggests to us that it is unlikely that these approaches will be organically adopted at scale in the current context. So what problems remain to be solved? I'm going to close by raising what we think are 4 big questions for today and beyond, in the hope that together we can do some more collaborative problem solving to achieve that potential of workplace savings. Firstly, there are barriers for providers in offering workplace savings. To be effective, emergency savings accounts need to be simple, flexible, instant access accounts without fees or withdrawal penalties. But we know that this is not where providers make money, and this kind of product usually requires some kind of cross-subsidy in any business model. There's not great appetite, therefore, to boost supply of this kind of account. Credit unions are really well placed to serve low to moderate income households, but they encounter particular considerations of their own. They need to stick within their common bond or agreed membership criteria, and there are limits on how wide that common bond can be. They also need to maintain a careful ratio between savings and loans. And for building societies, credit unions and fintech employee benefits providers, although that one-to-many relationship that comes with a workplace approach via employers can reduce some costs, payroll integration and multiple account setup requires infrastructure and investment. So how, therefore, could the supply of workplace accessible savings solutions be boosted? Secondly, coverage of workplace saving is still limited. Most employees don't have access to workplace savings, and that problem is particularly acute in smaller employers. So surveys of employer intent to offer financial wellbeing benefits to their employees are often focused on large and multinational employers, and that can distort our sense of the level of growth in workplace provision we might expect to see happen organically. We know from a recent nationally representative survey of employers we conducted, supported by the Aberdeen Financial Fairness Trust, that only 15% of employers currently offer payroll saving to all their employees. Whilst a quarter of large employers say that they offer payroll saving, only 3% of small employers, those with under 50 employees, do so. Most small employers don't have a reward lead or an HR head or someone in payroll to think about this sort of thing. They have limited resources, and importantly, most providers are not that interested in offering workplace savings solutions to them in any case because it's not viable to do so for a small number of employees. So how can coverage of workplace savings be extended to the half of UK workers who work for small businesses? Could we work with the infrastructure they have in place already via their payroll provider or pension provider, for example? Thirdly, we could get a false sense of achievement if we only fix the coverage issues. We want all employees to have access to a good quality workplace savings scheme, but that will only make a difference if they actually use it. We've seen that an opt-out approach can have a dramatic impact on participation levels, but that without it, participation can be very limited. There are regulatory considerations, including from employment law, data protection, and some of the financial services regulations, such as anti-money laundering and the need to, for example, acknowledge the FSCS protection scheme, that make it difficult for employers and providers to adopt these approaches. The picture here is actually really similar to that in workplace savings pre-auto-enrolment. Measures like increasing coverage via stakeholder pension requirements, trying to boost participation through engagement via the Informed Choice programme, just did not move the dial. It was only with the implementation of auto-enrolment that we saw participation get to more like where it could and should be for pension saving. We think that we have that evidence base for shorter-term emergency saving now, but without the regulatory comfort and clarity, employers and providers are unlikely to act at scale. So what would it take for our opt-out approaches to be widely adopted to support participation? Finally, we've learned a huge amount from these pilots about designing solutions around the real-world lived experience of saving, the difficulties people face in managing different financial priorities with limited resources, and the features and the communications approaches that can support them. So how can we optimise solution design going forward? What's the right balance of short and long-term saving? If employees have their own savings account already, could they choose to save into that instead of a default account? Is there a case for an in-between mid-term goal-focused savings pot to be included in a hybrid design? Additionally, what role might subsidies play in supporting the most financially constrained to build a savings buffer? We've seen that some employees struggle to build a balance over time because the money's going in and out frequently. And subsidies or matches could help these cases, but we know that take-up of the government's Help to Save scheme, which offers just this, has been much lower than expected. So how could subsidy be designed and targeted to those that need it most? And finally, should emergency saving be built into the next evolution of pensions auto-enrolment? In the context of widespread calls for a rise in the minimum mandated pension contribution levels, could diverting some or all of any increased savings first into emergency savings account build a safety valve for those who aren't currently in a position to save more for retirement and who are exposed and financially insecure today? There's lots to think and talk about, so we should get going. But whilst the first panel gets ready to come up, I want to hand the virtual microphone to a group of people who can bring all of this to life far better than me. Please join me in watching some of the savers from our trials talk about their experiences of workplace saving and of what it has meant for them. Thank you.
So you always need savings because you are always going to be faced with your car breaking down, you need new tyres, or your roof leaking. You just need savings as a backup that are accessible other than your pension, which obviously you can't access until you're 55.
It's important for me to have savings because if, for example, if anything was to go wrong in our house, like the boiler breaking down, a flood, weather damage to the home, and say, for example, it was going to cost us £500, we could never afford to just hand over £500 to fix a bill. You know, we would either have to go to a family member, take a loan out in the bank, or sell possessions. You know, we don't have that luxury of being able to cover ourselves and give us that.
So yeah, I do like that idea because once you get paid, obviously some will go into savings, which then makes it easier to save, and so it won't be as easy to dip in and out of your savings. And then also it'll be good, it's also a good idea to have that as a buffer and know that you have savings put aside.
It's taken off of payroll, so it's already taken from your salary. You don't need to make a conscious effort to put it away and to save. And I like how it is in a separate account, because then in my head it makes it harder for me to access, because I'm not seeing the balance there all the time or in my savings account. So it's just easier for me just to have it kept away rather than seeing it in my online banking, and then you almost forget that you even have it.
And the big difference for me is the money's removed at source. So what arrives in your normal bank account is what you operate with, and you tend not to pay attention to what you've got saved elsewhere. And I've just found that a easier process to follow than that of traditional saving.
I think it's a really good idea, because it means at the end of each month, that money's automatically going to be taken out of your paycheck, put aside, and it's going to make it easier for you and be peace of mind for you, because it's not money that you're going to have to worry about taking out each month, because it's automatically done for you. I reckon every employer should offer this to their employees, because I think it's a really good scheme, and at the end of the day it helps everyone out.
I know the money's there if I need it for a rainy day, or if the washing machine breaks down again, it's always there to help.
I just feel, for me, you can sleep easy knowing that it's paid for and you're not worrying about, having to make extra minimum payments, things like that, to try and get debt down, whereas it's already then accounted for because you've saved for it.
It actually feels a little bit empowering to be putting away this amount every month.
Having a JARS account really reassured me, knowing that if something was to happen, I had a little bit of money to take care of something. It put my mind at ease. It was stress-free. So, if I spent too much money on the food shopping, I could say, no, it's fine. Take a little bit of money out of there and top it up.
Saving with JARS, which happens automatically, is so easy. And I kind of felt, wow, I'm actually saving each month. That's something that I can do. So that put me to thinking, how else could I start saving? So then I said to myself, why don't we try 5% of your salary?
One of the things I found with saving being quite difficult to do and never quite being able to get there, this is the sort of first time I've had an opportunity to save, which gives you quite a nice feeling of self-worth, because you feel like you're achieving something for once without it all disappearing out of sight. And it's not for the big things, it's for the little things, like if your family come to stay, there's always more costs involved. You go and do more things than maybe you did before. The fact that maybe just something simple, like you could pay your insurance that year in one, and it's not direct debits, every month, making sure it's in the right place at the right time. So it's just that little hand, that little sitting on your shoulder, a little bit of security that you've got a little bit of money, and you've earned it.
Walk up during the video, but the video was so amazing we all forgot. we would have ruined it for you as well. Get that clicker. So, hi everybody. I'm really honoured to have been invited to moderate such an accomplished panel, and I'm looking forward to this session and hearing from our panellists. So my name is Sarah Peretta. I'm one of the executive directors at the Money and Pension Service, and I'm responsible for the UK strategy for financial wellbeing, our money, debt and pensions policy, and developing guidance services. I also lead our UK partnerships team, which is a group of regional managers across the UK that work with employers on the ground. Obviously, we've been hearing a lot already about employers today. And I also lead our innovation function, and we've been really sort of all of the people in our team are really excited to have been working on innovations such as sidecar savings over the last several years, and seeing the results of those coming to fruition is obviously hugely rewarding and really interesting, and gives us hope for the future of what we can do with savings. So when we published the UK strategy for financial wellbeing in 2020, we were already concerned about the state of the nation's financial health. That's why we brought the strategy together. And we laid out 5 national goals focusing on financial education, helping people build a liquid savings buffer, getting more people to save, helping people understand and access credit, helping them access better debt advice, and then knowing enough to plan for and in retirement. But hot on the heels of publishing that strategy, we obviously headed into a period, first of all with COVID, where people's household finances were thrown into turmoil, and then obviously now a much kind of more long-term outlook around cost of living challenges. So low to moderate income households face an ever more complex financial outlook. And that impacts people's priorities and decision making. It's difficult for people to know what to do next and where to put their money. So in this panel, we'll explore a little bit more around employers and what role they can play in supporting financial wellbeing. We'll look at how short-term savings approaches work alongside other savings goals, such as retirement. And then we'll also look a little bit around savings behaviours and how to design solutions that support those who are financially constrained or excluded. So each of our panellists is going to say a few words on those general themes, first of all, so I'll introduce them one by one. So first of all, Sarah Holmes-Burke, who has flown in especially for this event for a 3-day trip from the US, leaving her very young child behind. So we're very glad to have her here. And she manages a behavioural economics lab that studies financial wellbeing. She serves as an associate director of the NIH-funded I should have checked this with you because we had 2 minutes to check, but NBER.
That's right.
Yeah, Roybal Centre for Behaviour Change in Health, which supports clinical trials that explore the relationship between human behaviour and healthy outcomes. In previous roles at the Brookings Institute and Pew Charitable Trust, she studied retirement security and end-of-life care policy and managed the Brookings Papers on Economic Activity series. Sarah holds an MA in Public Policy and a BA in Philosophy from George Washington University, and her current job title is Research Project Director at Harvard University and the National Bureau of Economic Research. Sarah, that's quite a mouthful, very accomplished indeed. So over to you to say a few words.
Thank you. And thank you to everybody for putting this event on, to Nest in particular for being such a great research partner over the last few years. This is joint work with the rest of the team at Harvard. So that's John Bashirs, Jay Garg, and David Lapson at Harvard, and James Choi at Yale. In particular, I'll give a big shout out to Jay Garg, who is our research assistant and makes all of the analyses that I'm going to share later in my deck possible. It's very surreal to be here. Joe and I have been talking every Monday morning for 4 years straight, and so it's pretty incredible to meet all of you in person and see the fruits of a very long research process. So I'm just going to show a couple of slides, if it'll let me click. Okay, there we go. This is sort of rehashing things that have already come up, and I'm sure it's information that you all know. But as we've talked about already, a lot of households are living hand to mouth, and they just don't have enough of a savings buffer. So I'm showing here results from some surveys that Nest run to support the sidecar savings trial. And you can see here that only about half of households would have enough cash on hand to cover a 300-pound bill. And then on the right panel, there's a similar survey run by the Federal Reserve Board in the US. At first glance, this looks like US households are better off, but I think it's actually just a factor that we in the US were not asked or not given the option to answer, that we would use our current account but cut back on essential expenses. I think if the surveys had been identical, you'd see that US households are in roughly the same shape as UK households. And as we've already talked about, if you don't have that buffer, your options are pretty poor across the board. So credit is expensive, especially if you're in the population that doesn't have short-term savings. Asking friends and family members for help is great, but it's not available to everybody. A lot of people don't have anyone in their network that could help, and it's not a long-term solution. And then selling possessions, it's also not a long-term solution. In that great video we just saw, someone talked about maybe needing to turn to that route if their boiler broke. But what happens the next time you have an emergency expense? It's just not something that will support you in the long term. Lots of barriers that are limiting people from saving, and I think, again, that's well known to everybody in this audience, so I'll be quick. I think affordability is a big one that we just don't think about enough. If you are living paycheck to paycheck and you're just barely scraping by, the idea of saving anything probably feels impossible and scary. So it's hard to think about that problem, and I think we, as a community, need to acknowledge that it's not just about nudging people towards taking better care of their finances, but making sure that we're telling them the right, not telling them, but giving them the right tools to take care of their finances. Related to that is dealing with current debt. So the population that doesn't have short-term savings tends to have a lot of debt. And servicing that debt is important because the interest rates can be so high. I think people need a better understanding of how to prioritize paying off the debt that they already have and protecting themselves from taking on more, but it's a lot to juggle. Related to that as well is the need to save for retirement and other long-term goals. The policies of pension automatic enrollment here, 401k automatic enrollment in the US, signal that you need to save for the long term, you need to save for retirement, but it leaves people wondering, that's great, what do I do about tomorrow? What do I do about next year? And so without a good sense of how to prioritize, I think the retirement piece of the puzzle is just adding confusion. We need to help people understand these are the big things that are on your plate. Here's how you as a household would be best served to juggle them. Stress is another big factor. Joe mentioned cognitive load, and I think that's huge here. According to a survey that the American Psychological Association ran last year, 80% of American adults between ages 18 and 43 are saying that they're very stressed about money. In the surveys that Nest ran for the sidecar savings trial, over half of respondents said that they felt anxiety about their finances. And then on top of that, these are sort of exacerbating money problems because financial stress causes marital tension, it causes relationship tension. We know it's one of the leading indicators of divorce when there are money stresses in the household. Leads to performance problems at work, which of course can lead to more serious issues with income shocks and other negative financial problems. And on top of it, it's just overwhelming to deal with these budgeting problems when you already have stress in your life. So you might not have thought it coming from a behavioral economics side, but I'm coming to psychological barriers last because although I think they're very important, in some ways I think that you have to account for these other barriers before you can even start thinking about what are the psychological barriers in place that we can kind of help people overcome. A big one, and probably the most salient here, is inertia. You want to save. I love and hate that figure Joe shows with 46% of people say that they think jars would help them. 14 of them say that they're likely to save, and only 1 follows through. It's a devastating figure. But there's also issues like present bias, where you're so overwhelmed with meeting your expenses today that you can't think about what you're going to need 3 months from now or even 1 month from now. Mental accounting, all of your money is in one place, and that makes it hard for you to sort of mentally earmark some of it as being for a rainy day situation. And then last of all, as humans, we're not great at understanding what we're going to need. In the case of retirement, we don't know how long we'll be able to work, how long we'll live, and therefore how long we'll need to draw down on our retirement accounts. And it's very true in the emergency savings context as well. People are bad at predicting unemployment spells, cars breaking down, all sorts of things like that, just because it's a difficult thing to do and you don't think it'll happen to you. And so all of that really makes it difficult for people to save. All right, so I'm going to show just a few charts. This is from the JARS study. As Joe mentioned, participation was quite low, less than 1.5% at all the employers that participated. But the people who do save build useful cushions over time. So on the left, you can see the distribution of account balances among savers over time. The 10th and 25th percentiles are quite low, less than 100 pounds at all points in the study. But I don't think that's a sign of failure. I think that's a sign that people are using the accounts and tapping into them frequently. Sort of the conventional vision for emergency savings might be save, 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 draw down a little bit, and keep saving. But this use case could be protecting people from more costly forms of credit. So I think it is a success if people use their accounts frequently and don't accumulate much of a balance. You can see the median account, I think Joe gave this number as well, or getting close to 400 pounds. And then at the 75th and 90th percentile, we are getting quite large balances. At the 90th percentile, they reach 2,500 pounds almost, which is very exciting. On the right, we're showing contribution activity, and Joe talked about this a little bit too, but you can see the thick line at the top are people making contributions via paycheck to the short-term savings account, and then the dotted line is inclusive of contributions flowing to pension. It's actually quite a large proportion of accounts continuing to make contributions, which I think is really exciting. And then the thin line at the bottom is what we're calling ad hoc contributions. So these are contributions that people make outside of payroll. Maybe you've gotten a bonus or another influx of cash and you think, you know what, JARS is working well for me. I'm going to sock some of that money away in my short-term savings. We hadn't expected to see it at this level, and so it is really exciting to see so many people using their accounts in this way. So I'm going to turn next to give some previews of the opt-out emergency savings research we've been doing with Suez and TransSave and with WageStream and their employers. These are very exciting results. We're going to keep updating them as time goes on, but it looks really good so far. So this is showing participation in the two studies. On the left, we have the Suez and TransSave UK results. And as Joe mentioned, this is sort of a before-after cohort analysis. So the pre-AE or pre-opt-out cohort are people hired at Suez in the 1 year before Suez changed their policy. That happened on November 1st, 2021. And then the post-AE or post-opt-out cohort are people hired since November 1st of 2021. And people hired since then have been automatically enrolled in the short-term savings program unless they chose to opt out at a 40-pound per paycheck default. And the result is striking. That is about a 49% participation rate, and so more than a 45% increase in participation over the opt-in regime, which is incredible. The WageStream RCT, which has 3 arms, as Joe mentioned, has only been going on since late last year, so we don't have as many months of data, but what we're seeing so far looks really, really encouraging. You can see that in the opt-out arm, participation rates are, again, getting boosted by close to 50 percentage points. The baseline is higher at WageStream, and so we thought opt-out might not work as well in this context, but it did, which is really cool. The other big surprise at WageStream was the performance of the active choice arm. You can see that it's pretty evenly matched with the control arm, which was not our assumption going in. We thought that going in, active choice would be somewhere in the middle. Maybe there are things we could do to get it to the middle, but as you can see, it's not the case that opt-out is an unnecessary approach. It's clear from this chart that you need a strong approach to nudge people into the program. All right, I'm almost out of time, so I will be as quick as the clicker will let me. Okay, this is showing contributions from payroll into the short-term savings accounts, and I think here the most exciting panels are the post-AE cohort at Suez and the opt-out cohort at WageStream. You can see that in both cases, the median contribution amount is 40 pounds exactly. A lot of people are sticking with the default. At WageStream, it's over half, and at Suez, over 70% of the contributions we see are at the default. There are some outliers. At Suez, the highest contribution amount goes up to 1,000 pounds. At WageStream, it goes up to 190 pounds, but a lot of people are sticking with the default. It's clearly a comfortable number. We chose it for a few reasons. One, it's about 2% of pay for the typical Suez employee, which felt like a comfortable amount that would still let people build up a useful cushion at the end of a year. It's also pretty close to the typical wage drawdown at Suez, and it's close to what the typical existing wage stream saver was saving. Okay. If you're saving, you're building up a useful cushion pretty quickly. So in the case of the Suez trial, you can see that people in the pre-AE cohort, they're saving, they're bumping around at less than 100 pounds typically. Again, I don't think that is necessarily a bad thing for their savings outcomes, but you can see in the post-AE arm, people are saving a lot more, getting close to 300 pounds by the end of the period that we have so far. At wage stream, the arms actually look very similar in terms of their savings accumulation, and I think that is largely a product of the fact that we happen to choose a default that's close to what people who were opting into wage stream were already saving. But again, they're already building useful balances just in the short time we've been running this study. So we'll keep updating the results as we get more data, but everything is looking incredibly exciting and encouraging so far.
Great. Thank you, Sarah. I'm sure you could have given us another hour of analysis on that, so that was really great to get some insight. So next up we have Peter Tutton, who is Head of Policy, Research and Public Affairs at Step Change Debt Charity. Peter joined Step Change in April 2012, and he was previously Social Policy Officer dealing with debt and credit policy at Citizens Advice for a number of years. And then prior to that, he was Head of the Debt Advice Unit and a Debt Advisor at Citizens Advice. So Peter, over to you.
Thank you very much. I'll see if I can get the clicker to work. Oh, it's a challenge. Oh, look, that's just my title again. Right, there we go. So I work for a debt advice charity. It's the law that I must start with a gloomy stat. So I'll start with this one. I've got a long list, actually, but I won't give you all of them. It'd be too depressing. But some recent polling we did, comparisons. So tracking what we've done, polling we've been doing over the last few years. In March, we asked the question, are you struggling to finding it difficult to keep up with essentials? So in March 2020, 15% of respondents, YouGov polling, 15% of responders, about 7.5 million people said, yes, I'm finding it difficult to keep up with essentials. By September 2022, that was 45% of people. So that's 23 million UK adults. Actually, we did it again in January, the less gloomy bit of that we did it again in January, and the number hadn't grown, it had actually gone down a bit. So as we saw with COVID, you see a big build-up of impact, but then it kind of gets there and doesn't necessarily, as we are at the moment, keep growing and growing and growing. What that does mean is there's a huge proportion of people who are financially vulnerable and facing a long shadow. This kind of vulnerability won't go away. It also confirms your point, Gavin, that kind of there's millions of households in the UK who've been living with these financial pressures and cost of living pressures for decades, and certainly over the last decade we've seen it more and more. But now that vulnerability is heightened, more people are involved. So what's that translating in? Will it translate into more debt problems? And the other question is, when will it translate into more debt problems? So we're already starting to see it, and other debt advice charities and advice charities starting to see debt advice demand rising. And over a quarter of the clients that we're seeing at the moment are citing cost of living as the reason for their debt problems. So that is starting to translate into people needing debt advice. Interestingly, the impact of shocks, and when people sort of their debt problems getting so bad that they come to advice, can take quite a while. So half our clients wait more than a year before seeking advice, between starting to worry about their debts and struggle and seeking advice. We did some qual research last year, and we found that some of our clients, actually that process had evolved over 5 years, even 10 years. So some of the stuff, that bulge of 23 million people now, we might be seeing them in 5 years. We may be seeing them next month. We don't know. I mean, that's one of the things we don't really know. So it seems to have peaked for a moment, but we're seeing more. Amongst that, we're seeing more clients with deficit budgets. That's a very important thing in debt advice, because a deficit budget means that people have got more coming out than they have got coming in, which means it's very, very hard not only to deal with your debts, but to get back to some sense of financial health and resilience and planning. So that is growing at the moment. We're seeing more of those clients. Not surprisingly, we're also seeing more clients who are, in inverted commas, higher income. So what the cost of living crisis is doing is expanding the the band of incomes in the population that are vulnerable to financial difficulty. That's what it's doing. And what I'm going to talk about with that gloomy introduction, so I'll talk a little bit about the two-way relationship between debt and savings, if it'll work. Okay, so what this graph is showing us is this came from some research we commissioned a couple of years ago from Wealth and Assets survey data. And on the up axis is showing percentage reduction in odds of falling into problem debt, and the x-axis is showing savings. So what we're seeing here is really steep. The most important is the steepness at the curve at the start. So what that's telling us that actually a relatively small savings buffer immediately reduces and has significant reduction in your chances of falling into debt. So, for instance, £1,000 in accessible savings, and this analysis, £1,000 of accessible savings reduces the chances of falling in debt by about a half. So the nearly £400 in the JARS pilots is meaningful in terms of reduction in people's vulnerability to debt. Now, there's a question about, is that correlation or causation? People that are more able to save maybe being less likely to debt just because they've got more income. Perhaps, but I'll come to some stuff that we're seeing from our clients which tells another story as well. Let's have a look. So a lot of information on this, but this is essentially saying something in a different way to what you've heard from previous speakers. So this comes from survey work of step change clients, and the boxes at the top talk about really just how frequent it is that our clients tell us that they experience unexpected costs. Now, in the context of people that are in that process of financial difficulty before advice, because people generally are in a position, the reason why they're struggling is because they've had more payment commitments than they have income. Kind of in a sense, every payment is unplannable. So it's very common for people to have these shocks, and even actually after advice we find that people are still highly financially vulnerable to unexpected payments. The bottom set of rows is all about how people deal with it, and similar stuff as before: borrowing from family and friends, using credit card, using high cost credit and other forms of credit. So if people can't meet costs, can't meet essential costs, we'll often turn to credit, that credit that can be the start or a making worse of existing debt problems. So this is something from national polling we did a couple of years ago when we're looking at how people cope with larger life events and people's different coping strategies. Now, there's a lot of information on here, but the important thing, if you look at the dark purple bars, the things down the side are all different kind of ways people try to cope through things like unemployment, illness, relationship, a whole different bunch of life events. And the dark purple bars in particularly are whether people who did that, said they did that, also told us they showed signs of being in severe problem debt. Some of the things on there are things which are about there's one seeking money advice, seeking debt advice, which not surprisingly more likely to say in financial difficulty because it's kind of revealed. But some of them are things where people's ability to use an asset or use a particular coping strategy made their chances of falling into debt bigger or smaller. So there's a couple of really interesting bars. So you look about halfway down, high cost credit, got a payday guarantor load from high cost credit, 53% of people who said they did that experienced financial difficulty. Similarly, for other forms of credit are quite high, a bit higher up. People who use credit cards or an overdraft. Don't know why I'm pointing at that, by the way. It doesn't help because you can't see what I'm pointing at. People who use credit card or an overdraft, over a third financial difficulty. But if you look at the second bar, use savings to cover day-to-day spending, only 13%. If you look at the bottom one bar, took money out of pension pot, which is a different and more difficult in some ways, but another way of utilising savings, 6%. So there's a very, very strong kind of people who are able to draw on savings, again, hammering it home, people who are able to draw on savings are much more likely when they do hit an unexpected cost or an income shock to be able to cope and survive through that without experiencing very, very serious debt problems. This again just goes on to kind of what Joe was telling us earlier. We asked our clients if you could choose to have savings automatically deducted from your salary or benefits, would this make you more likely to save? Person going woohoo, 41% said would make them more likely to save. So kind of this sort of pre-predicts what the opt-in sort of the opt-out saving did. That if you do it for people, they go woohoo. So that's a useful thing. Now, this is, oh, hang on, I've gone too far now. No, yes, I have. No, I haven't. Sorry, there we go. Right, so this is a new bit of data that I dug out the other day, and I'm still not quite sure what it means, but I'll try and explain it to you. So, there is a thing that happens with debt advice clients. What we do is when we try and work out a sustainable budget for them, there's a thing called a standard financial statement, which is a kind of industry, a lot of you in the room may know about this, is an industry standard guide that's accepted by creditors and used by debt advisors to work out a budget for people. A really good innovation to that a few years ago was to allow people who have surplus in their budget an element for savings. So rather than all your available money going to repay debt, you can choose to put a bit towards savings. So I had a quick look at that the other day. 22% of our clients have got an element going to savings. So these are people who have come through debt advice and have come out the other side. And the average savings amount was about £18.50 a month. Not huge, but significant. The red and the green bits and the strange three-letter acronyms and so, on the side, they're different, on the left, they're different debt solutions. So the green ones, which are the high percentages, 43%, these are repayment solutions. So what this means is these are people who, after debt advice, have got some disposable income, some to pay their debts, but also to save. And a very high proportion of them are saving. That's quite interesting because it's showing a journey of people when they came to us are in financial turmoil because of their credit commitments and other commitments. They've got more coming out than they've got coming in. They can't plan, they can't save. It's a downward spiral. What debt advice does is picks up those commitments, and particularly their credit commitments, puts it to the side and rebuilds their budget. So what we have there is people who are in a sort of chaotic situation, and with an intervention, not only are they getting on top of their debts, but they are then able to start building financial resilience. Now that's important because one of the things we found that with people coping with credit, there's about over 4 million people using credit. This was before cost of living, so this was last year, beginning of last year we did research, over 4 million people using credit to keep up with bills and keep up with existing credit commitments. And one of the things there is people, when we ask them why they were doing that, they're very reluctant to speak to their lenders for help. All sorts of worries and real barriers about doing something different from what they were doing. But the net result was that they were 5 times more likely to say they were suffering mental health problems, physical health problems, relationship issues, or issues with their working life because of the stress they were under, because of these payment problems and because of their financial difficulties. And yet on the other side, we start seeing people moving to savings behaviour. So there's something there about that journey into financial difficulties that isn't right at the moment. And the long time it takes for people to get to help or being directed to help is causing harm, when actually this is quite fixable for those people. So that's one thing. The second thing is the ones in red are the people who have got little or no money. DRO's debt relief order is a type of insolvency. It's a very low saving rates, but actually we find as it goes over through time, which I'll talk about in a minute, that rises. Zero offers is people with negative budgets, no ability to save. So that point about the barriers to people saving, that some of those barriers are easily solvable and some are quite hard to solve because they involve larger public policy questions about income levels, safety net levels, cost of living, etc. That's what that's telling us. So sorry, there's a lot of text on this, but this is a good news story. I'm always saying. So this is a good news story, and then I'll finish. So we measure 3 months after, 3 months, 9 months, and 15 months after advice. We take cohorts of clients and we measure them against a bunch of outcomes. So first one is just showing the pandemic and pandemic and post-pandemic, these things change. So actually the circumstances and macro environment affect savings, but it shows people can save. The second one is at 9 months, which is I now have to save up money for the future. So it's saying quite a lot of people, almost 50%, and the pandemic being higher than post-pandemic, interesting. But 4 in 10 clients now saying they're able to save up, and that's 9 months after debt advice, which is a good thing. And using a more concrete example, do you have enough to replace a fridge or washing machine if it breaks down at 15 months, about a quarter to a third saying yes. So that's a sort of good news story that if you can get people on a stable platform, then they can start to save and their financial resilience starts to improve. And very, very finally, a whole load of text there, but basically that's what I'm saying, and the real summary of that is there are some quick wins and some quick ways to get people from financial harm to financial health, but underneath that there's a whole bunch of difficult questions, social policy questions for those people with persistent low incomes who's very hard to improve their financial resilience, and that's me. definitely. Yeah.
Fantastic. So next I want to introduce Helen Dean, Chief Executive Officer of Nest. Helen is one of the architects of auto-enrolment and responsible for bringing 9 million UK workers into pension savings. That's a pretty cool thing to be able to say about your career, isn't it? During her time at DWP, Helen was tasked with coming up with a solution to the UK's chronic undersaving in pensions. Her degree in psychology led her to behavioural economics. Finding compulsion too extreme, Helen and her team started to explore nudge theory. Fast forward a little while, and having designed and built the policy that would change the face of pension savings in the UK, Helen moved to Nest's predecessor, where she moved from policy to delivery. So Helen and the team were faced with a blank piece of paper and a big challenge to build a low-cost, high-quality pension scheme from scratch. And we all know what happened next. So thank you, Helen, and over to you to say a few words.
Thank you, Sarah. Can everybody hear me? Great. My goodness, I think this is an amazingly important piece of work. Really inspiring program. I don't think I've felt so inspired by a piece of work since I discovered the work that David Leibson was doing at Harvard University on auto-enrollment into pension saving. And I thought I'd try and illustrate for you why I think this is so important by talking to you about somebody that I know, somebody that I'm very close to, and what she's going through. So I'm going to talk to you about Susan. Susan works full-time. She works in a factory. It's a really tough job that she's got. She works really hard. She works on one of those big industrial machines, and it is just, you know, at the end of the day, she is absolutely shattered. She earns about £21,000 a year. She's married. Her husband also works in a factory, a different factory. He earns slightly less than she does, so together they're bringing in around about £40,000 a year. The thing that really mattered to Susan and John when they got married was that they should get on the housing ladder. That was really important to them. And they saved and saved and saved, and they got a deposit together, and they got themselves a mortgage, and they have a house. And that is probably the most important thing in the world to them, that they have their home. So they have their mortgage to pay. They also run a car. They have to have the car because the factories aren't really well served by public transport. They both work shifts, and when the shifts are difficult, there really is no other way of getting to work, so they have to keep that car going. So up to 2012, neither Susan nor John had any savings at all. They had just nothing. They were just living day to day, kind of worried about the future, worried about what old age was going to mean for them. Then they were both automatically enrolled into a pension, into their workplace pension, and have been steadily building a pot for retirement ever since. And that's great. You know, the pots are starting to build up. They're starting to get a bit more meaningful. But the really fascinating thing about this, the thing that took me by surprise, was the psychological impact for them of starting to save for retirement. You know, and when I talked to them about how they felt, the first thing, you get automatically enrolled, you haven't been saving before, how do you feel? You're just incredibly relieved. That thing that you've been worrying about for years, that you haven't known what to do about, that you think you ought to do something, but you're frightened of making the wrong decision, I don't have to worry about that anymore because it's sorted, it's happening. And then having got through that phase, proving to themselves over time that they could continue to save for a period of time. Then they say, well, after that, you know, the relief, it's not so much relief, it's actually pride. I'm starting to feel really good about myself. I am saving for my retirement. You know, I am consistently saving. That's a great feeling. I feel really good about myself for that. And then now as the account balances are starting to grow, they're starting to get a bit curious. So what are you doing with my money? And what is this thing called investment? And what does it mean? And what happens to my money? And there's definitely a sort of sense of financial awakening. So practically, it was important to them to get enrolled. Emotionally, it was important to them to get enrolled. But right now, times are tough, really difficult for them. So they are struggling to make ends meet. And, you know, as Gavin says, things have always been hard, but they're just getting worse because prices of everything seem to be going up. John actually is a bit of a gardener. He loves his garden, and he's got an allotment, and so he's growing his own veg. He got an allotment, started growing his own veg. It helps a bit, but the food bills are still really going up, and that's tough. The fuel bills, the monthly fuel bills, are just terrifying for them. And running the car is getting really difficult. Putting the petrol in, it's hard, but actually the car is getting older, and it needs more repairs, and that's becoming a real burden as well. After they've paid for all of the absolute essentials, you know, the mortgage and the fuel and the food and stuff, they reckon they've got about £300 a month left over. That £300 a month, they're just seeing that figure diminishing month on month. The available income that they've got to do something with just feels as if it's disappearing before their very eyes every month. They've got no savings other than the pensions. They've got no savings. They've got nothing to fall back on. They are feeling overwhelmed by this. They don't know what to do. It's really hard. John's reaction is a stress-related reaction. He's getting stress headaches. He's getting stomach pains. That's causing him to have more and more time off work. He's getting worried about his job and the insecurity of his job because he's having more time off work, which is causing him to have more stress headaches and more stomach pains. That's a bad spiral. Sue's reaction is a bit different. For her, she's just stopped looking after herself. So she's never needed glasses before. She needs them now. She's got the prescription. She hasn't got any because she can't afford them. She needs a coat. She really needs a new coat. She desperately needs one before next winter. God knows how she's going to get it. Her hair's a crowning glory. She's got beautiful hair. It's her one vanity. She can't afford to go to the hairdressers anymore. She's just not looking after herself. Her self-esteem's hitting rock bottom, and she's feeling quite depressed and quite isolated. Her family are in the northeast, hundreds of miles away. She can't get to see them because it just costs too much to go up in the car. It's having an impact on their relationship. Sue and John are starting to argue in a way they never have done before. They are worried. They feel constantly worried about the situation they're in. And Sue and John are by no means the worst case scenario of people that we might look at who might be in this sort of situation. They have a mortgage, they've got steady jobs, they've got a car. They're not in debt. They've managed to stay out of debt so far, but they live in constant fear of being in debt. They worry about money all the time. They describe themselves as being one unexpected bill away from trouble. That's how it feels. They feel like they're living on the edge of a precipice. And if that one unexpected bill comes in that they can't pay, then it's a payday loan, or it's an unauthorized overdraft, or it's sticking something on a credit card that they can't afford to pay off quickly. That's what it feels like, and that just feels like they're living on the edge of a precipice. It makes them feel vulnerable. It makes them feel insecure. It has an impact on their physical and mental well-being. They're not made-up people. They are people based on, they are based on people I know, but their situation isn't remotely unusual. There are millions of people in the country who are in a situation like Sue and John, in work, saving for retirement, underneath the bonnet, really struggling. Roughly, as we have said before, 25% of adults say that they can't cope with a £300 unexpected bill. It gets even worse for low-income renters. About 73% of low-income renters say they can't afford to pay a bill of around £500. 13 million people in the UK lack enough savings to pay essential bills if their income was to drop by 25%. That lack of financial resilience is not good for anyone. It's not good for the individual. It's not good for the employer. Employees who are stressed, distracted, more likely to be sick. It's not good for society, and it's not good for the economy. And yet the way out of it is clear. There is a way of helping which is clear and which is accessible. Households with even modest precautionary savings are much less likely to get into problem debt, as Peter has just told us. Sue and John, they reckon they can afford to put away about £25 each. That's £50 a month. In a year, they'd have £600. That would make a real difference. Good for them, good for their employer, good for society. And we know how to do this in the UK. We know how to give people a nudge. We know how much value we accrue when we do that. We've done automatic enrolment. We've seen the impact that it has. And now we've seen through this trial what could happen if we were to nudge people similarly into emergency saving. We had a historic partnership in the UK between government, employers and the pensions industry, and we delivered saving for millions of people. We delivered retirement saving, security and peace of mind for millions of people in the UK. So I say, building on the success of pensions auto-enrolment, we could develop an emergency savings programme for the UK to address the problems that people like Sue and John are facing. As an industry, we need to get on board with that. Because frankly, if the UK financial services industry isn't about helping to solve problems like this, isn't about trying to help people like Sue and John, frankly, then I don't know what it is for. Thank you.
Great, thank you all three of you. So I'm going to ask the panel a couple of questions now, but do put your thinking caps on because we've got some roving mics and we'll be able to come around the room and ask you some questions. And those listening online as well, Matthew in the room is moderating the online questions and we'll put some of those the panel's way as well. But I get to go first. So my question really is kind of back to Peter's point. How do you get more people to go woo? And we've talked a lot about savings, and obviously we're all fully committed to the idea and the fact that, and the evidence that savings are really good for people. But how do we get the prioritisation rate when people have lots of choices to make? So if someone's in debt, does it make sense for them to save at the same time? Which should they prioritise, short-term or long-term savings? So just thinking a little bit about those trade-offs, how do we unpack that a little bit? Would anyone like to take that one first? Peter, you're nodding.
I'll say a bit. So first thing there is to make a distinction with debt that is out of control, so problem debt, and then repaying down stuff what you owe, which are not the same thing. So one of the key things here is when people come to us and they're the sort of chaos that people experience when you get into this cycle of kind of having to constantly juggle bills and borrow to make ends meet. There's not a lot of choice going on there. It's sort of survival. It's it's people are getting through the next thing, which is why when people do reach out for help, it's very important that that they get to help, which is, whether it's reaching out to their creditors or whether their employer can help them, and so on, getting people to the right help. So that's the first thing. I think that the experience of our clients is that once people have got their debts under control and they've got some space to make a choice, and they actually can make a choice, they've got some money to save, then it's reasonable. I mean, once people are in a debt management plan, their interest is frozen. So it's not like they're saving 2% and they've got credit accumulating at 20 or 30% or 100% or 1,000%. They've got a genuine choice. And I think they're that balance of people looking to deal with their debts, which they want to do, but also the importance of building up that resilience. There's a question we ask our clients sort of 9 months or so after advice about, do you think you'll need debt advice in the future? And a very large proportion of them say yes, because their financial circumstances are still very, very vulnerable, and it will only take another shock and they'll fall over. So the idea of and also a very high proportion of clients, to Joe's point, we ask, how important do you think saving is? Almost all say very important. So there's a point there about it seems reasonable and sensible for people who've just been through the absolute washing machine of problem debt to encourage them and help people to get to a place where they've built up that precautionary rainy day savings. So when the next shock comes along, the cycle just doesn't repeat itself. So I think that's a kind of pension savings more difficult, but I'll stop there.
Yeah, great. Would anyone like to add to that one?
One thing that I'll add that surprised me a lot is in the context of the JARS surveys, we learned that a lot of people were not immediately thinking of the accounts as for an emergency, but for another short-term purpose. A lot of people said that they were saving for some other goal, and then were glad to have the mechanism in place to use for another purpose. And so I think one lesson, at least for me personally in the way I've thought about this, is that we, from an academic, from a policy stance, it's great to think about this as for emergencies, but a lot of the people who can be nudged into savings may not want to think about it in such a narrow light. And so it's nice for them to know that we want you to build up a cushion, it will make you better off overall, but it can benefit you in other ways too, to have a short-term balance available. And so letting people know that it doesn't have to be for some dark event that they hope never happens, where they lose their job or their car breaks down, but that it might be used for something that could feel like a positive thing to save towards.
Great. Sort of following on from that a little bit, Sarah, maybe you could start with this one, but when we're thinking about designing solutions and support for those who are financially constrained and unconfident and excluded, vulnerable, what are the kind of things that we need to think about?
Yeah, so I think in the context of JARS, we thought a lot about habit formation, getting people in who hadn't been saving, and then you don't need to save for short term forever. Once you've built up that cushion, it makes sense to flip it over to something else. And I think that mechanism could be used in a lot of different contexts. Right now, we see that the people who are being brought into the program entered it thinking they couldn't save it all. The qualitative research that Nest has done has shown a lot of people saying that it seemed totally daunting, totally impossible for their circumstances, but they did find a way to make 40 pounds a month work for them. And so I think if we can get people going, a hybrid approach is a really great way to help them meet multiple goals at once. So whether that's working towards goals simultaneously or helping them stagger in the right order of priority for their household, several different goals.
Great, thank you. Helen, I thought you might want to add something to that.
Yeah, definitely. I mean, I think it's really important, I think, to get people into the savings habit. Really agree. So there's something very powerful about doing that. So we need to make it very easy for people. So it needs to be really easy to start. Ideally, it's a nudge and it happens automatically. I think the other thing to remember is that when somebody's saving in this sort of way, the benefits are not just financial, they're also emotional. And those emotional benefits, the psychological feeling of well-being that comes from starting to save, and we saw it on the videos, is really powerful. We need to make sure that we design that in by giving people a sense of the fact that they are saving, feedback, well done, you're saving, your account balance has reached this sort of level, making it feel very close to them, making it feel very accessible for them. So I think there's something about making sure that you design the psychological benefits of saving, that sense of reward for actually continuing to save and watching that account balance grow, design that into the way we build the system.
Yeah, I think that's a really good point, keeping basically humans at the centre of the design. Great, so one other question is we've been focusing a lot about nudges and solutions in that shape and form today. But obviously financial education and financial literacy are part of this picture as well. So when, what are your views on that, about when is the right time for financial education and literacy and when is the right time for nudges? Who would like to go first on that one? Maybe Helen, you can go first this time.
Yeah, I mean, I'm happy to. Certainly, I think the experience with pensions auto-enrollment and similarly, I think with what we're seeing here is that nudges are great for getting people started, and there really is no substitute. It's just a great way of getting people started and into the habit of saving. One of the things, though, that I have noticed with Sue and John and with other people that I've talked to is the moment for financial, I think of it almost as financial awareness or financial awakening. I'm not so sure about financial education, but there's a moment where what you're doing becomes really meaningful to you, and I think that's the moment that we have to be really conscious of. So we use nudges to get people saving. You allow the balances to grow a bit, and then I think people are then ready to engage, they're ready to understand. They will become curious about their savings. They will become curious, certainly in the pensions context, potentially about what's happening with their money. They may become interested in things like whether the money's been invested responsibly, what is the impact on the environment, all of those sorts of things. So I think we should try and get people into the savings habit and then follow that up with some financial awareness. I worry about financial education, though. We shouldn't expect people to become that really financially literate. Why do they need to? You don't go to the doctors expecting to be medically literate. You need to go to the GP and you need to be confident enough and aware enough to ask the right questions and to be a good customer of those services. But you do expect your doctor to advise you what to do. I think expecting people to become very financially astute is unrealistic. Frankly, they've got better things to do with their lives. We need to make people better customers of financial services, certainly more conscious of things like charges and more literate in that way. But I think when we talk about financial education, we should be much clearer about what we expect, the skills and abilities that people really need that will make a difference.
Great. I'm conscious we've got just over 10 minutes left, so I might open it up to the floor now, see if anyone has any questions out there. Great. So, gentleman, third table back first.
Great. Thanks, Mick McAteer from the Financial Inclusion Centre. We also have a sister organisation called Action for Financial Inclusion who runs the Work and Save programme in Scotland. We've got 23 of the biggest employers in Scotland now offering payroll savings. They employ a total of 100,000 employees. I think my question is, we all know payroll savings works. We know what the problem is. We know what the causes of the problems are. We know what works. I think my question is now, what do we do about it? How do we persuade employers and other trusted intermediaries like debt advice charities or social housing providers to actually offer payroll savings or else provide access to payroll savings? This is all very, very interesting research about consumer behaviour, but it strikes me that the people we need to be influencing, that we need to understand in the first instance, is the behaviours and the barriers of the trusted intermediaries who can provide access. So how do we get it off the ground here? How do we actually roll out payroll savings so more people can get access to it? Yeah.
Right, so a question around scaling up.
So one thing I'll point to is a report that Jo mentioned in her remarks about the employer experience. I think that's really, really important because, the employers who are a part of these studies that I talked about and Jo talked about are pioneers for agreeing to let us test these ideas on their employees. So anything we can do to show that the experience has been not just neutral but positive to other employers feels like a really important step in the right direction.
I'm happy to go next. Mick, I suppose I would say this, wouldn't I? But I think we need to repeat what we did with pensions. We had a historic partnership, didn't we? So government, the pensions industry, and employers got together, thought long term, built a national consensus around doing something. In doing that, resolved both the demand and the supply side. And made a huge difference. So I think it's another partnership between the industry, between employers, and I think there is a role for government here. I suspect the easiest and most effective way to do that is to use the infrastructure that we've already built with pensions auto-enrollment, where we've already got payroll saving happened, piggyback on that, amend the regulations that already exist for auto-enrolment to create a feeder account so that people build their pensions up in part via building up a short-term emergency account. It tips over once it's built to a certain level, but it means that we're building that financial resilience in automatically. We've already demonstrated that's good for pension savings, so I don't see any threat to the pensions reform programme, and in fact there is arguments that it'll enhance it because it's easier to create persistency. So for me, the answer is it's the next phase of the great reform programme that we've had going on in this country for the last 15 years. Time now for phase 2.
Just to add to that, so Step Change is a participant in the JARS pilot, and we're a debt advice charity. Our employees know a lot about debt. We know, but the take-up's fairly low. So this point about kind of you encourage people to do it, the defaults work against you. So exactly what Helen said, you know, it's like people who are quite knowledgeable about debt and financial health and all these things still don't necessarily join in a scheme where there's the defaults are you have to opt into it. So the research, this research is showing quite clearly that kind of you change that default and you change the rate of people's savings. And the finding that it's not affecting pension saving, we commissioned some research from Pension Policies Institute in the stuff to model if people were using the original sidecar, which would be a bit of your pension pot that was liquid savings, and people saving to that and then using it a number of times over their life to deal with emergencies, had a very, very small effect on final pension saving, and actually a positive effect, as I remember, a positive effect in likely to keep people saving rather than dropping out of auto-enrolment because of their financial difficulties. So I absolutely agree. It's making that step because the public benefits are so high of moving the default.
Right, I think we'll take one more question in the room, lady in green at the front, and then we'll take one online, Matthew, as well, if that's okay.
Thank you. Is that working? Yes. Hi, I'm Sam O'Sullivan. I'm the policy lead at the Chartered Institute of Payroll Professionals. It's Tax Administration and Maintenance Day today, and I know. And my team have very kindly made me aware that the Help to Save scheme, it was extended, that it was going to be, it was announced it was going to be extended. They've just published a new consultation on that. So I think that shows that the government are aware something needs to be done about it. However, that's for people who are in receipt of certain benefits. Is this the prime opportunity for everybody to respond to that consultation and say that, you know, a Help to Save scheme should be available to more individuals? More of an observation, not necessarily asking your thoughts immediately. A second observation, if there's time, Joe, you mentioned earlier that with increase in pension contributions, maybe that initial increase should go specifically into savings in the first instance. At the CIPP, we're working closely with the PLSA, and they've put a report out there saying that pension contributions should be lifted from 8 to 12 as a minimum contribution. Maybe, again, we suggest that that 4% increase in the first instance should be put into an emergency savings pot. I don't know what your thoughts are on that, as to whether that could be a suggestion, and do you see that working?
Quick reflections.
Quick reflection
Pithy
is,
ones.
I could be really quick, because I just 100% agree with you on both of them. Definitely think it's a fabulous idea for that additional pension contribution to, first of all, solve the emergency saving problem. Definitely. And we should all respond to consultations and say that.
Right.
Nothing more to add.
Okay, well, we'll just go with that. That really was pithy.
Thank you.
Thanks. Matthew, do you have a great question from the virtual floor?
Interesting, the most popular topic by far on Slido has been about government interventions as well, and Helen, Peter, you addressed quite a lot of that in your last answer, but there was also a question about whether incentives, actual financial incentives, should be part of how government supports and promotes this scheme. And then I thought one which might be suitable for Sarah, because she's seen the numbers, is whether this kind of intervention is particularly helping fill the gap in savings among younger workers particularly?
Yeah, so we have data for the Suez trial on age, gender, broad role. And we are seeing that it's working equally well, basically, across those. We don't feel like younger workers are being left out, like either gender is being left, any gender is being left out. And then for wage stream, we have some hourly pay data. And for Suez, we have wage data as well. And we're seeing the same thing. In our current analyses, we break folks down into wage terciles, and it looks like opt-out is working equally well across those pay bands. So it's very early, it's very preliminary, but like right now, I'm not seeing a sign that people are being left out for those demographic reasons.
And then on incentives, does anyone want to pick up on that?
Yeah, I'm happy to have a go. I think it would be great to have some financial incentives in the system. I think one way we could think about doing that is to look at the amount of money that's in the system in terms of tax relief on pensions, which is quite regressive at the moment. If we could repurpose that expenditure towards incentivizing lower earners to save more in the short term and for retirement, we could do it in a cost-neutral way to the exchequer and have a huge impact. There's a lot of money there.
And the only thing add to that is to look at disincentives as well. So we're in the situation at the moment where Help to Save, great scheme, aims at people on UC, tax credits, helping people to save. At the same time, the government is deducting tax credit overpayments from people's UC. And amongst our clients, about 90% of people having those deductions saying it's pushing them into a negative budget, causing severe hardship. So government interventions, I think on the savings, yes, but there's also some other things that can be done, which are more generally about looking at people's financial health and things that can mitigate harm from things like debt collection that may get people to that safe platform to then be able to save. So there's a bit there as well.
Great, thank you. So I'm just going to attempt to say a few words to sum up. I am the only thing standing between you and I think a coffee break now. So, I mean, I think there were I was trying to come up with 3 words to be pithy, but the first of these I think is the great vision that is required to really build this kind of evidence base. And I think we've really seen evidence here of people having that great vision. The second is commitment. So I think what we've seen with this trial and the work that many people in this room are working on is a genuine commitment to innovation and accepting that innovation means sometimes you find out things don't work, but you just keep coming back and thinking about ways that they can work. And that really bears fruits. And then there's also a commitment in the sense of longevity as well. So this has been a number of years to build this evidence base with a number of partners really committing to see this through. And that is a rare thing, but that's what's required to make this kind of change. And then the final one is a word that many of the panelists have used today, which is partnership. So I think there has been an incredible partnership to get us to this stage, a non-competitive partnership to really share learning across the globe, as we've seen with Sarah's attendance here today. And when we're thinking about the future and scaling up, partnership is clearly required to take us to the next level as well. So I think, I think this is a really great example, as Helen has called out, of something that has the potential to really change the shape of the nation. And we need to keep our foot on the gas and retain the ethos of what's made this a success so far. So I just wanted to say thank you to our brilliant panelists. And I am right, it's a coffee break now, haven't I? I haven't promised something for you. So yeah, round of applause please for our panelists.
I believe that the live stream is now back open. So also welcome back to everyone who is listening and viewing us online. I'm Gemma Gooch, and I'm the co-president of the BlackRock Foundation, and I also lead our social impact team, which is all our philanthropic efforts that we do as a firm. And as part of my role, I have the real pleasure of working very closely with Will, with Joe, and all of the Nest Insights team through the BlackRock Emergency Savings Initiative, which, as Gavin referenced right at the beginning, was a philanthropic initiative that we launched in the US and in the UK back in 2019 to help low and middle income earners build protective short-term liquid savings to strengthen their financial well-being. Our hypothesis was that we needed to really meet people where they were, meet people in their place of work through payroll. And we are so pleased to be able to share the learnings today and celebrate the sidecar savings results shared by Joe earlier, but also really very encouraged about the direction now on auto-enrollment. And there was such passion in particular around the earlier sessions, and I hope that you all feel energised that there are significant barriers to overcome, but that there is, and really there are really strong, there's a massively strong growing evidence base, and there are solutions, and this is feasible. The cost of living crisis, as we know, is hitting incredibly hard. We know people have been struggling. Before then, it has only added an additional layer for so many more people to be included in those financial struggles day to day. And we really wanted to shine a lens on those struggles that many UK households are really struggling with on a day-to-day basis. We couldn't think of anyone better to do that than Dame Claire Moriarty, Chief Executive of Citizens Advice. I'm really thrilled to welcome Claire today to help us paint that picture of an understanding of the current cost of living challenges and show how vital it is that we continue to find ways to help the most vulnerable in our society build financial resiliency. Before taking up the Chief Executive post at Citizens Advice in 2021, Claire served as Permanent Secretary of the Department for Environment, Food and Rural Affairs between 2015 and 2019, and thereafter as Permanent Secretary of the Department of Exiting the EU. In 2017, she was actually appointed the first civil service faith and belief champion to represent all faiths and beliefs and promote interfaith dialogue. And so, as such, she is a staunch advocate for diversity, equity and inclusion. After her extensive career in the civil service, her accomplishments were recognised by her appointment to Dame Commander of the Order of the Bath in 2020. Claire is going to speak for around 20 minutes or so, and we will save time for questions in the room and also online afterwards. So please save them up for Claire. Claire, over to you.
Thank you very much indeed, Gemma, for that very generous introduction. I'm delighted to be here today talking to such an engaged audience about such an important issue. It's really great to see so many different organisations coming together to think about innovative ways to improve people's financial resilience. So I joined Citizens Advice 2 years ago yesterday. After, as Gemma was saying, many years in the civil service, the things that drew me to Citizens Advice were, and it's a very strong, we're a social justice charity, that sense of focusing on the things that really matter to people. But also, there is something very interesting about how Citizens Advice works in terms of very much a focus on people as individuals and individual circumstances, but also, we are strongly powered by technology and by data. And one of the things we can do, and I talk about the kind of unique feedback loop, is we can link up, we can join up from the individual stories of people who are coming to us for help through the data that we collect, the insights that provides to think about policy solutions. So when we propose policy solutions to government, we do so on the basis that we know there are things that would make a difference because the propositions come from the direct experience of people coming to us for help. So let me just pause for a moment on Citizens Advice, because people, almost everybody knows our name, but not necessarily who we are and how we work. So we are what's called a federated charity. There are 250 odd local charities all independent local charities who are at the heart of their communities, and we come together under a single brand and with a kind of common purpose and common direction. We deliver a huge range of services, a core offering, the traditional citizens' advice offering of generalist advice. People just, they turn up off the streets. In reality, these days, more often off the virtual streets on the phone, with all manner of different questions. But we also deliver funded services. So we deliver the help to claim service for people making an initial claim for universal credit. We deliver pension-wise and very importantly, debt advice contracts for the money and pension service. And that debt advice work is particularly important for today's conversation because it forms the basis for much of our ability to analyse deeply the financial pressures that people are under. We are the largest provider of debt advice in England and Wales. Each year, our debt advisors collect around 60,000 detailed financial statements from people in debt. And that gives us an incredible insight into household income and costs, including, because the numbers are so big, really good breakdowns of demographic characteristics. And over the last 18 months, we've been putting that data together with lots of other data coming from the people who are seeking help to create the cost of living data dashboard. If you have not come across the cost of living data dashboard, I cannot commend it to you too highly. My colleagues have done an amazing job to pull data together in a way that's very visual. It's also very interactive. You can play around. You can look at different demographic characteristics. You can find out a great deal of what's going on. And we have been building it up so you can see what's been happening over a number of years. You can see what's happening. Some of it's map-based, so you can see what's happening in different parts of the country. But it is really telling the story of what is happening in this cost of living crisis. And what the dashboard is telling us is this: the kind of highest, the top level figures. So around 200,000 people needed some form of crisis support from us in 2022. And we define crisis support as people who need a food bank voucher or they need help with charitable donations. So this is the real sharp end of crisis support. And more people contacted us because they couldn't top up their prepayment meter in 2022 than the entire previous decade. And what's particularly worrying at the moment is that the numbers that we're seeing so far in 2023 are worse than what we saw in 2022. So we're all waiting for the moment when these trend lines start going down again. But at the moment, they are still going up, and in many cases, they're still going up more steeply than they were. So between January and March 2023, the numbers seeking crisis support were up 20% on the numbers last year. So we saw 64,000 people in the first quarter of 2022, 77,000 in the first quarter of 2023. And what's called self-disconnection, people who can't top up prepayment meters, is still going up very, very steeply. So around 2.5 times as many people in that first quarter of 2023 came to us as in the first quarter of 2022. So these are problems that are not, they're not going away. And amidst, these are big numbers, but it's really important to focus on the human stories as well. And that's one of the things that we particularly do as Citizens Advice, because this is all about, real people with their issues. So stories like the countless parents who tell our advisors that they are skipping meals in order to be able to put something on the table for their children. A disabled person who came to us having struggled to cope with rising energy bills, got into debt with their energy supplier, and then found without warning that they had been switched over on their smart meter to prepayment mode, so they were left without gas and electricity over Christmas. So this is very much about individual people's circumstances. And what we're seeing at the moment is adding up to really worrying early indications of a personal debt crisis. Effectively, that's a crisis in financial resilience. Now, that should be no surprise. Many of you will have seen that COVID-era graph where those who had most savings ended up with more savings, and those who had least savings burned through their savings during that period. So that really kind of stark picture. So, over a couple of years period, people's savings diminished, and then over the last year, now 15 months, maybe 18 months, there's been a sustained squeeze on incomes, huge increases in costs, and particularly energy, but not just energy. And there's really nowhere for people to go, so they are running up debt. And that lack of resilience really matters. If you kind of zoom right out and look at how we went into COVID, after the recovery from the financial crisis of 2008 was very much, it was very much a concrete-led crisis accompanied by an era of austerity. We saw inequality increase, we saw resilience reduce. We went into COVID with a high level of inequality. We had a poor experience of COVID as a result, and we came out of it with inequalities even wider. Michael Marmot has a famous phrase, external shocks amplify existing inequalities, and that's what we've seen. So we are now in a position of even greater inequality as a society. There will be another global crisis of some sort along. They come along about every 10 years. So there will be another one along come the end of the decade. And if we don't address these issues around inequality now, we are going to be in an even worse position faced with that next one, which is why it's so important to be having these conversations now, using the time that we have to address these issues. So we're talking today about emergency savings, which are in many ways a direct measure of financial resilience. So increasing savings must be a good thing, but that's easier said than done. Here again, there's some really important lessons from our data. So, lesson number one, more than half the people who come to us in debt now are in what we call negative budgets, which essentially means that their essential outgoings are more than their income. A few years ago, that was around 37%. So that's gone up, really substantially over the last few years as this squeeze has bitten. If you're in a negative budget, you're likely to be in debt, and that debt is going to build up. You're going to be falling further and further behind with each month that passes. And if people aren't even in a position to repay debt, they're not going to be in a position to save. We know from our data that problems aren't evenly distributed. We can dig into all sorts of variations between people. So we know that being a private renter, being self-employed, from a racially minoritized group or living alone are predictors of not having enough to live on. So you are more likely to be in a negative budget if you're in one of those groups. So when we think about ways of encouraging people to increase savings, we need to think about those different groups and the circumstances they're in. But having said that, the problems are definitely not limited to people who are just in low-paid roles or in receipt of benefits. While private renters are most likely to be in negative budgets, what we're now seeing is mortgage holders amongst those who are seeing the most significant increases in costs. And the deficits that they face can be far larger than those faced by social housing tenants. So again, we need to be careful not to fall into easy assumptions about who is likely to be in a better financial position than who else. One of the starkest figures that I keep coming back to, so one of the things we look at is what level of income would you need to not be in a negative budget. So, what's the basic level of income that on average people would need to be able to meet essential outgoings with income and be, in kind of Mr. McCorber terms, you've got something slightly, you're slightly above zero. In 2019, if you had an income of $7,000 a year, you would probably not be in a negative budget. Now, that figure is almost 16,000, and that is close to what you would be earning on minimum wage, on a kind of full-time minimum wage job. So you need to be in that full-time job on minimum wage just to be able to make the basic numbers add up. And that tells us something quite important about who is going to be struggling to save at the moment. It's clear that the cost of living crisis is far from over. We're still looking at inflation in double digits, and some of the things that drive inflation have got quite long. They come through with a lag. So, food commodity prices go up, then producer prices go up, then consumer prices go up. So we're not at the end of some of these issues. Energy prices are forecast to fall, and there's a temptation to see that as, okay, well, it's, we're out of the woods, it's going to be okay. But the reality is that if you look at the forecasts for July and for October, they are at the level that energy prices went up to in April 2022, that kind of around £2,000. Now, we sort of collectively as a nation took our eye off the ball there. So if you go back to the early part of 2022, we were saying when energy prices go up to £2,000, lots and lots of people are really going to struggle. We got to April and almost immediately we started worrying about what was going to happen in October. And we didn't really pay much attention to what was happening. But we know, again, from our data, that many, many people struggled then. And as when prices come back down to £2,000, those people are still going to struggle, and many other costs have gone up in the meantime. So we expect to be still in a position where we're breaking a lot of unwelcome records on a regular basis. We think that's going to need action in a number of areas. There are some things to do with debt relief. We need to reform the plumbing to reduce the risk of people struggling. One element of that is better regulation of IVAs. As we see the debt time bomb grows, we need to make sure that there are debt solutions available for people and that people are being encouraged and supported into the right debt solutions for them and not the wrong debt solutions. There needs to be thought about supporting people on low incomes with emergency support to keep the heat and light on over the winter. And we need to look at what are the ways of reducing expenditure on essentials for low-income households. We've done some work with the Social Market Foundation and Public First and come up with a proposal for a strengthened social tariff in energy. But there are other essential services where we're going to need to have that sort of social tariff. And key point on the energy social tariff is it needs to be targeted, but it needs to be targeted on a broader group of people than those who are on means-tested benefits. It feels like something of a blind spot for government. If you look back over a year's worth of cost of living measures, they have either been things which are universal or near universal, which are very expensive, untargeted, do help everybody, but they don't distinguish, or else they've been things which have been targeted on people on means-tested benefits. There's a practical reason for that, because the government has the bank account details of people on means-tested benefits, so it has a means of putting money into people's bank accounts. It's much harder when you get to people who are outside that means-tested boundary, but we know that there are now millions of people who are struggling to pay for their energy in particular, who are not on means-tested benefits, and there really needs to be a way of targeting those people. So we need to think about ways of getting money to people who are not on benefits. So that group, the group of people who are in low-paid jobs, not on benefits, are particular concern and possibly least resilient to the shocks that we may see coming. So I think that highlights a couple of points relevant to workplace savings. First, as our data shows, there's a need to understand different groups at quite a high level of granularity and think about what works best for them. The second is about the need for longer-term thinking. Over the last few years, going back through COVID, we've seen a series of short-term crisis responses, and what we're now seeing is a growing group of people who are unable to even cover their essential living costs, they're building up debt, and for whom the idea of saving is an almost impossible dream. But it's precisely that group for whom financial resilience is so important. That points to a structural problem at the intersect of low pay, social welfare, housing, energy, no doubt other policies. And fixing that is going to require some really long-term thinking. But there are people who can't save now, but who might hope to be able to do so in future. And so from where we're seeing it, while right now might not be the most propitious moment to try and expand savings massively, it is certainly the time to be developing and embedding the mechanisms that are going to support savings. We need to kind of mend the roof while the sun shines, make sure that there are mechanisms in place so that we don't head into the next crisis in no better shape than the last. There is a very clear need to build up financial resilience. We know from our work at Citizens Advice that debt in normal times is overwhelmingly the result of some sudden life event, whether that's illness, relationship breakdown, losing a job, or a sudden unexpected expense that people can't cope with. So making it easier for people to save by smoothing the customer journey, incentivising saving could help people build up that little bit of financial resilience that they need to avoid what could be a relatively small unexpected cost plunging them into a deep crisis with all of the knock-on effects that has. It's important to recognise that improving financial resilience isn't just the job of individuals. It isn't also just the job of government. There's a clear role for businesses, including financial services institutions, thinking about what they can do to act in the interests of customers. And there are obviously clear benefits to employers in helping support their workforce to build up their financial resilience, particularly when you think about that, the small tipping points that can put people into very difficult circumstances. One of our kind of really things we're really committed to in Citizen Advice is taking a holistic approach. So we don't look at people in relation to individual problems. We look at people as people. We support people as people with what is usually, there may be a presenting problem. There's usually a set of circumstances that they're dealing with, and we can see that there's a place for all of these different kinds of interventions to help people overcome the challenges that face them and become more resilient. Thank you.
Thank you, Claire. So we've got a few minutes left for questions, but if I may start. So Claire, you've been 2 years in seat now at Citizen Advice, and it's a two-pronged questions. The first question is really what surprised you the most around UK households since moving into this seat? In particular, you have a completely different lens on things. And secondly, what gives you hope actually about the future? I mean, you painted quite a gloomy picture. So what is it that gives you hope about the ability for UK households to really, look forward and start to build financial resiliency?
So I think those are both very good questions. I think what surprised all of us was the speed and scale with which the cost of living crisis developed. So when I started 2 years ago, our services had been, largely, they'd gone from being mostly face-to-face, in-person, drop-in, to being completely remote overnight. And the big question was, how do we find a new normal in terms of service provision? What do people need? What do they want? It was very much about how we deliver services. And then very quickly, we started to see energy prices going up. We saw energy firms failing. We saw the consequences of that for consumers. And then we saw these very big increases. And so just how dominant that's become, and the degree to which these figures, the number of people who simply cannot get by without food bank vouchers. That's the most basic thing. So an awful lot of what we deal with is the bottom of Maslow's hierarchy of needs. It's people's basic physiological needs, and the number of people who are in a position where they cannot heat their homes and cannot put food on the table without that sort of help. I think what gives me hope is that people are incredibly resilient, and it is people will they find ways through, and the people coming to us, they don't give up, and our advisors, who are fantastic people, they don't give up either. We're operating in quite a difficult environment at the moment because many of our traditional solutions don't work that well. Traditional debt advice is predicated on, if you do income maximisation, then you help people manage their budgets, then they'll have a little sliver with which they can start to pay off their debts. If people are in negative budgets, then that sliver doesn't exist. And so lots of the things that we would have helped people do, which would have been relatively straightforward, helping people switch energy supplier, we're not doing that at the moment because there's no point. And so it's a difficult environment. I think what's encouraging is that people are looking for ways through. People are not giving up, and there is that sense of we get through this, and even though we've been getting through a lot of things over a lot of time, things will get better.
Thank you. Are there any questions for Claire in the room? Matthew?
We do have one from Slido, which is there a need for greater regulation on some of the drivers of financial insecurity? For instance, gambling advertising or buy now, pay later targeting?
Yes, both of those. I'd say both of those are things that we have in our sites at the moment. Buy now, pay later. We've been saying for certainly all the time I've been in Citizens Advice, and I know it goes back before that needs to be much better regulated. It's really easy for people to to find that they have clicked on the thing that causes them to buy now, pay later. It's very easy for people to kind of run up debt that they don't really have proper visibility of. There aren't affordability checks, so that is certainly something that needs attention, and gambling likewise. I think they're part of a broader picture. We're interested in online choice architecture generally, and the thing about we all do much more online, and it's very easy. It's very easy to make things slick, and for lots of us, that's fantastic. It's brilliant to have a really smooth customer journey straight through. I know what I want. I'm going to get it. There's a really important question about how much friction we should be collectively bearing in order not to have systems which are so slick that they either cause people not to notice what they're committing to, or are frankly abused by companies who've got much more information than individuals. So we've looked at some of the things like subscription traps, which are going to be an element of subscription traps will be addressed by the government's new legislation. But there's a broader issue. If you take out a free trial, really. You should be asked whether you want to continue it. You shouldn't have to kind of hack your way out through the jungle of processes. So there's a whole set of things which really do need proper looking at.
So Matthew, there were a couple of questions that I saw popped up around the role of the employer and also the role of, I think the question said top politicians, but government, and that was certainly something that came out of the sessions of the last panel. About what can government do here? Do you want to answer that one?
So, I mean, obviously, you've all spent a lot of time talking about the specifics of supporting schemes that encourage people to save, and I mean, ultimately, anything that requires legislation needs government to do things. I think I'd say there are short-term things that government needs to do, like addressing the fact that we are in danger of heading into winter 2023 with millions of people in the same situation that we were in 2022. Sitting in the cold and the dark, not being able to eat enough. That is an issue that government definitely needs to address. Longer term issues. I mean, energy is the big driver at the moment of cost, and as well as the social tariff issues that I mentioned, energy efficiency is another really important issue. About a third of many people's heating bills is actually just going straight out through the wall. So it definitely isn't it's not everything is for government, but it's really important that some of these things which require either incentives to be put in place or regulation or straightforward providing that safety net that looks after people and meets their needs.
I could do one more from Slido, or if there are any questions in the room.
There's one over here.
Thank you. Can you hear me?
Yes.
Hi, Maddie from JP Morgan Chase Foundation. So my question, I guess a lot of the discussion today has rightly been about savings, given the topic. But obviously for somebody who doesn't have that buffer of savings, there is also the question of what comes next as an option. And that often can mean credit. So just interested to hear, I know we've got some credit unions in the room today, for example, but just thinking about the role of affordable credit providers and how that kind of sector can also be supported, because I think those savings conversations also are fed into by that the other option for some people, which is credit.
Yes, and certainly I know we're part of quite regular discussions across the sort of the third sector about affordable credit, and affordable credit can make a huge difference. There are the kind of classic examples. If you can provide somebody with a loan that enables them to buy a washing machine, you reduce their costs of doing the washing in a way that has a material impact on their overall financial circumstances. And we know that the affordable credit market has been quite squeezed over the years, and some of the things, every time something changes, the answer tends to be let's reduce credit. So the debate going on at the moment around the consumer duty is, well, the consumer duty will mean that there's less credit available. And we've got to get to a position where that's not the response of the financial services sector, is just to withdraw people's access to credit. When people are in a position where there's kind of, as it were, planned credit to in ways that can help people manage their finances. I think we're also concerned about people resorting to effectively kind of unplanned credit, high cost, high risk credit. We've seen particularly where people are getting, where people are struggling to afford their rent. People don't, most people will do everything they can to avoid getting into rent arrears, because if you get into rent arrears and you're evicted, you don't have a roof over your head. So what we're seeing is people borrowing in unsafe, in high risk, high cost environments. And so again, it's partly about, a system in which the number of people who we're currently seeing, for whom, the numbers just don't add up. Low pay, low social welfare, high housing costs. Housing costs have got completely out of kilter with the amount that you receive towards them if you're on benefits. Energy costs, the numbers don't add up. So there's a question there which shouldn't rightly be solved through credit, but obviously credit is a really important part of an overall system in which people can make decisions. If they've got savings, that's fantastic, but sort of properly structured credit is another part of the answer.
Thank you. Unfortunately, I think we're at time. I know there's another question, or do we have time for one more question? No, I've been asked to move on. I know that we have to keep to time because of the live stream. Thank you so much, Claire. It's been great to have you.
Thank you. It's been very, very good to be here. Thanks.
The first test is, have we managed to sit in the order we were told to sit in? I think we have. Okay, well, thanks everyone again for joining us. So we're moving on now to our next panel, which is very much on this question of scaling participation. I have an absolutely brilliant panel to help me talk about that. I'm going to introduce them in just a moment, but first I'm just going to take a couple of minutes to make some comments to try and introduce the discussion. So Malcolm said earlier, well, look, we've got the evidence. The first thing I want to say is let's pause for a minute. That's not nothing, right? It's taken a very long time to build this evidence base. I think even as recently as a couple of years ago, we had a very clear sense of the evidence around the problem. What I think we have now is a much more powerful and comprehensive evidence base around the solutions that could help to address that problem. And Helen and I were talking the other day, and Helen said something to me that was quite striking, which was, look, there's more evidence for this now than there was for pensions auto-enrolment in 2005, right? The scale of the evidence for the applicability of this as a set of solutions to a set of problems is at least as powerful as the evidence base that created that coalition that Helen was talking about earlier. So that's a great place for us to be, right? That is a really, evidence-based policy making is really important. It's a great place for us to be. And then Malcolm said, but how do we get people to do it, right? So what comes next? How do we achieve that scale? I just want to come back to something Jo was saying in her introductory comments. There is a bit of a temptation here to take the kind of field of dreams approach, right? If we build it, they will come. And if we keep talking about our brilliant evidence base, everyone will turn around and say, oh, great, well, we should do this. Employers will do it. Providers will provide the solutions. Employees will take it up. And that does not, to us, seem likely starting from where we are starting today. Okay, there are challenges to the building of it. So there are supply side challenges, as Jo said, to people providing these solutions at scale. There are challenges to employers in taking them up, and in particular, there's a challenge at that nexus of this might not be worth doing for employers without an opt-out mechanism, but for employers to employ an opt-out mechanism, there are an additional set of challenges and hurdles and concerns that make that harder for them to do. And then, of course, we know that without that opt-out mechanism, there are barriers to individuals in taking up the solutions that are provided. So that's the point of this panel, is to hear firstly from people who are at the coalface as providers, as innovators designing solutions, as employers who would like to see more of this, but who are experiencing real-world barriers in how to deliver it and how to scale up that adoption, and then hopefully to also talk a bit about their views on the solutions, what would help unglue that scalability and lead us to a place where the MAP's objective of 2 million more people saving is realisable in practice on the ground. So in order to help me do that, I have Emily Trant from WageStream and Roger Shelton from TransSave. So these are two different provider-side models, both of whom we're working with on our existing opt-out trials, who bring different perspectives on how those have been made to work, but also the challenges. We also have Mariel Beasley from the Common Sense Lab, who will bring very much that innovation perspective, thinking about how can this be done from a US perspective, but super relevant to us as well. And then Pete Glancy from Scottish Widows is going to talk a bit, both as an advisor to employers and from an employer perspective himself, as to how they have thought about this kind of solution and implementing them. So we're not going to do any slides. We're going to do this in a reasonably kind of discursive way. I'm going to throw a bunch of questions at each of our panelists in turn. They're going to talk for a few minutes. Then we'll go into a more conventional kind of Q&A afterwards. So Emily, turning to you first, I'm hoping you might firstly tell us a little bit about WageStream, who you are and what you do, who your customers are, and then maybe move on to talk a bit about your experience of offering payroll savings. What do you hear from employers? What do you think the barriers are to them for taking up? What do you hear from members? And also, in particular, love to hear any reflections on, as a partner of ours in building an opt-out model, what have been the challenges that you've experienced with that, and any reflections on those? So Emily, over to you.
Brilliant, thank you. First of all, it was so cool to see our data on screen. Thank you, Sarah, for kind of putting that together and sharing it with everybody. That was really, really an exciting moment, and brilliant to have one of our employer clients in the room. So Alex, big shout out to you for being part of that with Co-op. Who are WageStream? We are an employee benefit. We're a financial well-being toolkit. So we sell to employers who tend to have low to moderate income workforces. They're often deskless, so doing jobs they have to go to work to do, and predominantly hourly, but kind of not exclusively. Our wider toolkit does a number of things, but broadly, we show people how much they're earning. So we show them the hours they're working and the pay they're accruing in real time. So they use that for budgeting and spending decisions. We have a financial coaching module. They can chat to a real trained human coach about sort of various financial topics. We allow them to access their pay flexibly so they can choose the pay cycle that meets their needs. And we have a savings product. We call it our build product, or our build pot. It's all about rainy day resilience. And I wanted to take a couple of minutes to talk about who the people are that use our app. So kind of our members, as we call them, and kind of their lives and circumstances. And there's been a lot today so far about, portraits of different circumstances. So Helen gave us kind of Sue and John. We've heard from Claire about the sorts of people coming through Citizens Advice and the various structural barriers. But I just want to take another minute and talk about the lives of people on low to moderate income, particularly those who are on hourly pay. So in our WageStream membership, about 70% of individuals are on hourly pay, and that has a couple of impacts for them. So firstly, when they get paid changes month to month, because when you're on hourly pay, someone has to do the job of logging your shifts, checking they're accurate, calculating your pay, and then paying you. And that's typically run on a 4-week pay cycle. So your payday is not the same month to month, which can make it incredibly challenging to manage your bills and manage your everyday expenses. The second thing to say about hourly pay is, again, what we see in our data is it varies a lot. So the amount of hours you work are a really big driver of your overall resilience. And we see an average fluctuation of 37 hours month to month for someone on hourly pay. So if you sort of take that through the national living wage, so the government's minimum wage for people 23 and over, that's £385 and change, fluctuation month to month on average, on a payday that changes month to month on average. We see that it's predominantly women, so around 65% women. Women are more likely to be in lower paid work. They are mainly the bill payer in their households. They're very often the prime or only bill payer in their household. And you can start to see how these challenges begin to layer, where somebody is getting paid on a different day, they don't know what their hours are going to be, the amount they get paid fluctuates, And then you want to talk to them about savings. Like, are you kidding me, right? This is incredibly challenging for people who are trying to make ends meet with a cash flow that's moving all the time. So these are the people that we're serving, and this is why it's so important for kind of employers to be at that intersection, because they have a really vested interest in outcomes for these individuals. In terms of our experience with payroll savings and kind of what that's looked like to date, I just need 30 seconds to tell you how we operate as a business to kind of help tee up how this is going to work. So we consume payroll and time and attendance data from our clients. We also use e-money, so we use e-money accounts to move money. So we can move money on behalf of the employer. We move about £10 million of salary annually on behalf of the employer, and that means we can also move money on behalf of the individual. So using that information about how much somebody is working, how much they're earning, and our ability to move money, we've been able to create our build pot, our savings proposition, where at the point of pay, they can choose to move some of that money into their build pot. And we have designed our solution specifically for, like I said, people on fluctuating incomes, where they can't necessarily commit to a fixed amount. And so when we launched our build proposition in 2019, we actually built 3 ways for people to create that contribution. So the first way is the really simple, put X amount of pounds aside a month, roughly £40 was sort of the median amount we saw, and sort of do that every payday. The second thing that we created was what we called build the pennies. So when you are on hourly pay, as 70% of our membership is, rather than committing to a fixed amount, you say, for every shift I work, let's round down the pennies to the nearest whole pound. So if I've worked a shift and it's been worth £92.47, that 47 pence gets skimmed off and put in your build pot. So you're saving that 47 pence. It doesn't sound like much, but it adds up to roughly the same amount. But it's much easier to commit to, I'll just round down the pennies, rather than I'll commit to a fixed amount. And then the third thing is, when people use our flexible pay feature, they can kind of spend and save at the same time. So each time they use flexible pay, they can also designate a contribution that goes into their build pot. So as they're doing that income smoothing, they can kind of build that additional resilience for next time. And so because we've built it in this way, really thinking about the wants and needs of the people who are using the product, we have what I think is really extraordinary participation. So our baseline is around 20%. And we're hearing in the room that other baselines are around kind of 1.5%, maybe 5% if you're doing really well. And that's because we've designed a product that really meets the needs of that workforce. It's connected to their pay. So their pay is something that's incredibly engaging. Nothing engages people more than showing them their pay, letting them use their pay, letting them do interesting things with their pay. And we've made it really frictionless. So we've managed to work with some of our EMI providers around making sure that the experience of opening up that build pot is virtually frictionless. It's a closed system, so the source of funds is always the employer, so the pay is coming from the employer. You can't put money in any other way. It's purely a payroll savings proposition, which means we know exactly where the money comes from. We've done very detailed KYB on the business owner, and we can sort of navigate that regulatory complexity to make it work really effectively for that user base. So that's kind of us and our experience of payroll savings. In terms of why don't more employers do this, I guess the first thing to say is the employers we work with all do this. So we're in maybe a little bit of a bubble where the people we speak to are really interested in broader financial well-being, broader financial resilience, and savings is incredibly important to them. But we also do speak to employers who are thinking about that and maybe shy away from it. And they tend to shy away not just from savings, but kind of the concept of financial well-being support or financial well-being toolkit more broadly. And I think you can kind of bucket that into three reactions. The first would be employers who they have a sensitivity. They feel like if they talk about financial well-being or savings, they'll get backlash, and people will say, well, why don't you just pay us more? And so there's a sort of a conflating of the two issues, that giving someone a toolkit is not the same as paying someone more. The second thing we see is a real disconnect. So often the buyer or the decision maker has a very different financial life to the one I just described in terms of our members, and they either don't understand the problem, so I don't see it, therefore I don't understand it, or they only see the outcome, they don't see the inputs into that problem, and they think it's a capability and an aptitude point. And Helen sort of brilliantly earlier spoke about education. They want to see education as the answer, and quite frankly, education in of itself is useless if you don't give people a toolkit to act. So you need to give them a way to act on their education. And then the other, why don't they do it? Well, it's hard. It's hard to do this as an employer. You're worried about national minimum wage compliance. You're worried about how you get it done. If you're going to do it yourself, it's an awful lot of work to get that set up. You have to do the payroll reconciliation. It's not an easy job to do. So there's lots of reasons why people don't do it. But the power of doing it is incredible, as we saw from the results Sarah shared earlier. And actually, for us, being part of the AutoSave research trial or the opt-out savings research trial, that was actually easy. That was an easy decision to come to. It was easy for us to build. We, running randomized controlled trials is how we do things at WageStream. We're used to doing that kind of work. We had actually built and launched the trial before we'd finished signing the three-way legals between WageStream, Nest, and Harvard. That was the hard bit, the legals. But there were some things we had to think about. We had to work really hard on the user experience and the comms to make sure that it was really smooth, but not too smooth, that we were taking enough moments to interrupt people and let them know what was happening. So that was really important for us to think about. As a rapidly changing fintech, things have changed since we launched the trial. So we've had to keep an eye on, we've renamed the product, we've moved where it lives in the app, we've been extending the number of e-money providers we work with. So we've been looking at different regulatory flows and models there. And I think the final difficult thing for us has been kind of regulation as a whole. It's been very complex to navigate that. I have a lot more I'd love to say about that, but I'll kind of pause now because I think I can see I'm at time.
I suspect we might come back to that topic later in the discussion. But that was great. Thank you, Emily. And Roger, just to kick us off, broadly the same set of questions for you. Can you tell us a bit more about TransSave UK and who you are, and then just your own reflections on how it's been trying to encourage the build of workplace emergency savings and the barriers you found, and also your experience working on developing opt-out?
Sure. So TransSave UK is a credit union. We work in partnership with around 80 employers in the UK to provide workplace savings and loans. And I think it's fair to say, as a provider in the workplace savings space, promoting emergency savings is very much at the heart of what we do. And I think we say that because to join and access any of our services, employees have to commit to saving regularly through payroll into an easy access savings account that we administer for them. And those that do so are predominantly medium to low paid workers, and the average savings balances peak around 2,300. So we're not talking about investment savings here. We're talking about people building up liquid savings so that they have an emergency savings pot, or they can save towards short-term savings goals, or possibly a mixture of both. And I think what's interesting and rewarding and exciting about this is what many of these employers tell us, is that they wouldn't be saving anything, or they'd be saving very little, if they hadn't been given the opportunity to save through payroll. Payroll saving has been the mechanism to get them to save. So it's great for the employee because they're more in control of the finances, and it's great for the employer because they've got a more financially resilient and less financially stressed workforce. So that sort of begs the question then, if this is such a successful model that works for everyone, it works for all parties equally well, why are we needed to talk about scaling up participation at all? Why doesn't that scaling up happen automatically? And I think in our experience there are a couple of challenges. First challenge is that not enough employees sign up when workplace savings schemes are in place. And in fact, with credit union workplace savings schemes, our baseline is higher than the figures that were mentioned earlier, where our baseline is around 10 to 15% of the workforce participating over time. But that's still 85 to 90% of the workforce that never participate. And I think there tend to be two main reasons for this. Sometimes the problem is a simple lack of awareness. The employee's not seen or engaged with internal communications from the employer. But I think more often than that, it's about inertia. They're aware of the solution, but this sort of inertia sets in, something they want to do, but don't get around to doing it. So then, from a provider perspective, it's like, how do we nudge them into that sort of behaviour? And there's a number of things we do. So, for example, we provide financial incentives in the shape of referral programmes and savings accounts prize draws. We also provide marketing support to employers and financial education services to employee partners as well to help raise awareness. So there's a real range of things we do, but while all these measures can be helpful to a degree, they don't radically scale up participation on their own. And that's why the opt-out savings trial with 2 areas that we're involved in that you've heard quite a lot about today is massively exciting, and I think represents something of a paradigm shift, because by ensuring that employees are automatically opted into a workplace savings scheme by their employer, and they have to opt out if they don't want to participate, all these problems that I mentioned around awareness and inertia just disappear at one stroke. And as you also heard earlier, we're seeing a dramatic improvement in participation. So participation rates up from 10 to 15% to 40 to 50%. So I think as long as employers can be persuaded to get involved in opt-out savings schemes, the future participation rate looks rosy. But that sort of brings me to our second challenge, which is that to scale up participation, we need more employees to sign up to workplace savings schemes in the first place. And in our experience, it's certainly the case that many employers really do get the need for workplace savings schemes, and they understand the contribution that financial well-being can make to their business. 12 years ago we had 1 employer partner, and we've now got 80. So, we've been able to onboard a lot of businesses great businesses that really get it. But to do that, we've talked to hundreds and hundreds of companies who were pretty resistant to the idea. I think the stat was quoted earlier that 25% of UK employers claim to offer workplace savings schemes. That doesn't sound right to me. I think it's less than that. Maybe some of these people aren't being completely honest, but anyway. And it's important when I talk about hundreds of employers that I'm not talking about SMEs here, but typically we've been talking to larger companies with over 500 employees. So they don't have the excuse that an SME does, that they're just flat out running the business. They in theory have the resources to look at this, but they're still quite resistant. Why is that? I think it's understandable to a point. Employees will often focus on perceived risk and cost as opposed to reward. And I think Emily did a really good job in her presentation in talking about some of the issues and conversations that come up, particularly when they're trying to convince a CFO or a CEO rather than a HR professional. But I actually think it's something bigger than all that. And I think in reality it really comes down to one thing, and that is that they're not required to do it. It's a nice to have rather than a must have, but there are other priorities for the business. And it's just not something that ever reaches the top of their agenda. Which sort of leads me to my final point, which is that if we want to see a dramatic increase in employers signing up, then maybe policymakers need to step up to ensure that employees have some sort of obligation to provide workplace savings in the same way that they're obliged to provide occupational savings schemes. And this was obviously covered in the last panel. So maybe in this case, that's the paradigm we need to change. Well, that's pretty much my 8 minutes or slightly less, so thank you.
Brilliant. Thank you, Roger. So we're going to pivot to a slightly different perspective now, and we've got Mariel Beasley here with us from Common Sense Lab in the US. So Mariel, perhaps you firstly tell us a little bit more about Common Sense Lab and who you are and what you do, but then I think there's a couple of things we're sort of hoping you might kind of talk to us about. So one is at the sort of US policy level. We know there's been some changes recently that have specifically tried to open up the way for this kind of thing, so really interested to hear a bit more about those and your reflections on any initial insight into whether those have been effective or whether they might be effective. And then also you yourselves have worked on an innovation in this space that you're going to tell us a little bit more about, and what your kind of lessons, takeaways from that have been. And yeah, so let's hear from you on those, and then I'm sure there's plenty of other things we can come back to after.
Great. So Common Sense Lab, just to get started, is a behavioral science research lab based at Duke University in the US. So we really focus on applied behavioral science in the financial domain. So we look at how can we partner with credit unions, fintech, employers, sort of everybody you can think of that touches people's financial lives. How can we partner deeply with them to use behavioral insights to design changes to products, policies, features, things that they are doing in order to help people increase savings, decrease debt, increase long-term savings, manage expenses, sort of that wide gambit. And we've been doing this for about 9 years, and mostly in the US, but a little bit outside as well. So
this is just, first of all, a huge, massive, sort of coming from the side of trying to convince partners to do this. First of all, just a huge, massive congratulations to the Nest team and the partners to help pull this off, because I can tell you that is not easy. We have been trying for years and years and years to get an employer to do something like this. So just, it's an incredibly huge lift that really, it's sort of a perfect storm of the right people coming together to make that happen. So first of all, big congratulations on that across the board. Additionally, so in the US, I'll talk a little bit about some of the stuff that we've done in absence of being able to do something similar to this. But as mentioned, as Will just mentioned, there has been some pretty significant legislative changes in the US. Actually, just in December, Secure 2.0 was passed. This was pretty significant retirement legislation that was really aiming on, aimed to increase the number of people participating in retirement. It aimed to increase how much people could put into their retirement savings. It was pretty wide sweeping and had lots and lots of different pieces to it, all related to retirement. Now, except for one of the really, really interesting pieces of this was that there were two additional sort of provisions in there that allowed employers to essentially allow their employees to access $1,000 in case of an emergency without penalty. So typically in the US, as in many places, if you want to access early your retirement savings contributions for an emergency, they have to be sort of very specifically qualified in order to not get penalized. And essentially, one of the things that this legislation did is that they said, we're now going to allow employers to allow their employees to access up to $1,000 without penalty for a variety of different emergencies. And we're actually going to also allow employers to allow their employees to self-certify. So the language that I'm using is pretty specific. It allows employers to allow employees. It does not mandate. It does not require. There's still a ton of opt-in for an employer in this space. So that's one component of it. The other component that focused on the emergency crisis in the United States, the emergency savings issue that as Sarah pointed out, mirrors pretty closely the situation in the UK, was allowing employers to offer a paired emergency savings account that folks could actually put money into and save up to $2,500 that then they could pull out and tap however they wanted. But it could sort of be offered within their retirement product. Now, this is a huge step. I don't want to downplay it. Any type of massive legislative change around retirement savings is meaningful. Most of these changes actually don't go into effect just yet. Many will start in 2024 and a couple in 2025. So that's hopefully when we'll start to see what does opt-in rates look like for employers. I would also note that the emergency savings account piece in the legislation, it also allows employers to do auto enrollment into it. So that is a big, important piece. Again, it allows employers to do that. It does not mandate that employers do that. Interestingly, however, just one added piece to this is that one thing that did also change, not related to the emergency savings, is that back in 1998 is when legislation in the US first said that employers could auto enroll into retirement savings. So that was in 1998, so 25 years ago, right? And yet even still, there's a lot more adoption across the US of employers automatically enrolling, but even my own employer, Duke University, you still have to actually opt in. 25 years later, after saying employers can now go ahead and do this. This is a university that very much knows the research about the importance of opt-in and opt-out, and yet it's still not sufficient. However, this new Secure 2.0 says all new 401k plans, this is our retirement plans and 403b plans, all new plans actually now are mandated to be auto-enrolled and auto-escalate. So you have to auto-enroll at least 3% and then escalate up to at least 10%, or up to a max of 10%. So 25 years later, we first said we're going to give everybody the option. Almost nobody did anything for the first 8 years. In 2006 is when we actually started to see employers starting to actually adopt it and opt into that auto-enrollment. And now, just now, it's then decided to become mandatory. And actually, we're going to require employers to auto-enroll people. So legislatively, it seems like there's been an understanding that there's this transition of, we're going to allow it. Oh, actually, it turns out we need to require it. So we are not yet seeing that in the emergency savings. We're still in this very first space of we're going to allow employers to try to opt into it. My hope is that it'll be a little bit of a faster adoption, but my hunch is that we might also get to a place where it becomes a mandated piece as well. But at least the groundwork has been laid. We have adamantly tried in the US, even prior to Secure 2.0, to find employers willing to auto-enroll into emergency savings for all of the reasons that you all have already outlined. People understand that it is massively beneficial. All of the research suggests that this is an incredible way to help people save. This is especially effective for people with variable income because, and we've done surveys and all of these things to help sort of demonstrate that, look, people want different ways to be able to save, and connecting it to payroll is extremely attractive to people because it allows them to account for the variability in their own income. It is a savings tool that is designed for sort of most of the population. However, as soon as you get into a conversation with somebody at HR or in payroll who says, well, wait a second, is this legal? Even if it is, which it is, especially now, if you even start that conversation, it's too late, right? Essentially, because what we found is that so many of the employers that we work with, even if they believe that it's important, they know that it's true, they're thinking about risk and they're thinking about effort. And if there's even the tiniest bit of risk and it's going to require a good bit of effort, it becomes a back burner. Employers have tons of things that they're trying to figure out and trying to work on, and tax, tax rules and figuring out how they're complying with local taxes is already a full-time job for a whole team. And so getting them to also commit the effort to something that is new and different and not required, even if they understand it's important, it just hasn't been helpful for us. It's been very difficult for us to make movement in that. And so instead, we actually ran a pilot with a credit union where we said, we want to do everything we can to make this look exactly like payroll because we understand the importance of this connecting it to pay, understand the importance of having it be a percent and variable and all of this. So we partnered with this credit union, and it took them about they were extremely committed. We have a long history with them, so they like us, and so they wanted to kind of comply with what we were asking them. And it still took them about 2 years to figure out how to pull this off. And essentially, for all new, we piloted this at a single branch of the credit union with all new credit union members who were coming in to open up a checking account. They were asked, do you have access to a workplace retirement program? If they said no, then they were told, great, your new checking account comes with a now and later account. So this is actually a hybrid model. And what that meant is that every deposit that went into their checking account would get swept into the now account, which is your emergency savings account, up to $500. When it hit that $500 cap, then it would sort of waterfall into the later account that had all of the same sort of normal restrictions of a retirement savings account. So it has a higher return, but it also has penalties on withdrawals, et cetera. And then if you dip into that emergency savings, then that next sort of transfer from your checking account off of a deposit into your checking account would go back in to refill that first bucket and then spill back over into the longer one. So we started this pilot back in the fall. And in the first 4 months, we're talking at one branch. This is sort of a stellar branch. So it's much smaller than the Nest pilot. But we actually found a 78% acceptance rate. That is huge. Now, it's very, very small numbers. So we expect that as more people sort of participate and as we expand to more branches, that number will come down. But this is 78% of new credit union members who did not have access to savings said, wow, this product is great. I'm keeping it and I'm using it. And we found that people came in and made manual deposits to help get them to that later account. Now, interestingly, is when we had just the later account, because we had piloted that actually a few years ago, it was just a similar system just for retirement, we found about a 40% acceptance rate. And so actually the inclusion of the automatic savings piece of the short-term savings appears to potentially have actually made the whole thing more attractive. So not only did you all of a sudden have people saving for emergency, you had more people who were not saving for retirement also saving for retirement. So a hybrid model, a little bit different, but we had to basically look for other options because in the US it was just very difficult to get employers to opt in. I'm optimistic that at least within 25 years we'll have some employers in the US that are more on board for this.
Thank you so much. I mean, so much we could follow up on that. It also draws a really interesting bridge, I think, across from the work we've been doing on workplace emergency savings into self-employed retirement savings, and maybe that's a place we'll go in some of the questions as well. But before we do that, I'm going to turn to Pete Glancy. So, Pete, I think we've heard from someone on the savings provider side, the sort of innovator side. I think you're going to bring us a bit of an employer perspective, both from employers you speak to and advise, and yourself as an employer in thinking about whether and how it's possible to offer this kind of tool and your experience of that. So
yes, of
over
course.
to you.
Yeah. I'll do my best. So just in case you don't know who we are, Scottish Widows, we're a provider of pensions, investments and insurance products, and we're part of the Lloyds Banking Group, which includes organisations like Lloyds Bank, Halifax and Bank of Scotland. As we heard earlier, the cost of living crisis really brought the nation's financial resilience into sharp focus. And as an organisation that has savings accounts and ISAs and pensions, including workplace pensions, and a lot of digital technology, we wanted to have a look to see, is there anything innovative that we could do, come up with a concept that might work for our own colleagues and our own organisation and the sorts of clients, employers who have workplace savings products with us. Is there anything that we could do make work as a product? So we spoke to Insights to start with, and what we were trying to do is to see is there any early learning from some of the trials and pilots that we were hearing about already. And there seemed to be some challenges to overcome in terms of contracts and employment and opting people in, and financial services and conduct rules about introducing people to new products and product suitability. So to make our concept easier, we were looking at something whereby it would be on an opt-out basis, so we could get as many people in as possible, but also all of the money would be new. We wouldn't be diverting anybody's existing savings or earnings to something new, and all of the money would be from the employer. So we thought that on that basis we would overcome a lot of the contractual, behavioural and regulatory challenges. However, what we ran into with the concept was why we weren't able to take it further were a few more operational and logistical challenges, and I think Will and Joe were keen to share those with you today. So our target clients, if you like, in the workplace pensions market look a bit like our organisation. They have relatively generous pension schemes, and they also tend to have broader flex benefit packages. Now, that's not to mean that organisations that have generous pension schemes and flex benefits don't have lots and lots of workers on low wages or who encounter the sorts of financial difficulties through life circumstances that we also heard about earlier today. They do. So we need to consider those types of organisations in our solutions as well. And what we were trying to do, we were trying to test whether we could get a mechanism which looked a bit like the JARS approach, whereby we set up a short-term financial resilience vehicle where money goes in there in the first instance from the employer, and then there's a tipping mechanism where that money, when it reaches a certain level, tips over into the pension, and that was generally what we were trying to test. We came up with a few challenges with those types of employers. One was that where the employer contributions or the pension scheme are quite generous, there's often a tiered charging structure. So the more money that the employee contracts put in, the employer contributions go up at a matching level. And it became quite a complex mechanic to try and overlay that tipping mechanism where little bits are randomly going over from the bank account into the pension scheme without a formal contractual sign-up to increasing the contribution. So that was one of the challenges. We also thought that in terms of bringing a solution to market more generally for employers, that we could do a lot of the build work, so that we could take a package solution to employers on a plate and say this will be easy to roll out in your organisation. But an awful lot of the build work has to really take place in payroll and in flex benefits. So some of the logic is in payroll, a lot of the communications, the opt-out, etc. might be built into flex. So we didn't think that as a provider of workplace pensions we could go to the market and say we've got this great idea to help build financial resilience in your organisations, but most of the cost and effort will be with you. We didn't think that many employers would sign up to that. So I think where we got to is that we do think there's great merit in this. We understand all of the stats and the outcomes from the other trials. But we think for this to work, it really has to take place on a statutory basis. It needs to be an extension of auto-enrolment, as Claire was mentioning earlier. And if it's taken forward on a statutory basis, an extension of auto-enrolment, the payroll providers and the flex providers would build that statutory basis. We wouldn't have potentially tens of thousands of employers around the country going to their payroll providers and flex providers asking for a bespoke bill. That's unmanageable. It needs to be on a statutory basis. In terms of the polarisation potentially in the market, there are some employers and their workforces who can afford to put an extra pound into financial resilience and an extra pound into pensions, in terms of the pension industry wanting to get that step up from 8 to 12. But there are other organisations where the employer and their workforces don't have those £2, they only have £1, and that's where the money into the short-term savings jar with the tipping mechanism, I think really works quite well. So in terms of a statutory solution, we probably would need to recognise the polarisation in the market between employers and workforces, and it might be that if you're a pension scheme is sufficiently generous that you still need to put in place a statutory savings vehicle, or you might want to put in place a statutory savings vehicle for financial resilience, but you don't need to go for the tipping mechanism. And some of the employers that we work with, the combined contributions can exceed 20%. I know a couple of employers where the combined contribution is 30%. So people at 30% could potentially be over-saving for the retirement. So they don't need a mechanism that tips short-term savings money into something that's already that generous. But it might be that there's a generosity threshold. If the employer scheme is above a certain level, you don't deploy the tipping mechanism element of the solution. So those were really our findings, Will.
That's absolutely fantastic. Thank you, and thank you to all our panellists for their opening comments. I'll throw it open to questions from the floor in a few minutes, but I'm going to ask a couple of questions first. And I guess, sorry for what might be both a long and in the detail question, but I'm sort of fascinated by the US case study, where both with pensions auto-enrolment and now with emergency savings auto-enrolment, you've gone through a cycle of permissive or enabling legislation first, and then later, at least on the retirement side, a mandate. Now, clearly, people in the room have already spoken about the idea or the potential to incorporate emergency savings into the existing mandate that we have in the UK, but that is likely to be politically difficult, right? And sort of getting into the consensus around pensions auto-enrolment and potentially changing it, that could be difficult. Whereas, at least in theory, permissive or enabling legislation that makes it clearer that employers can do this if they want to, and by this I mean the auto-enrolment, may be easier to achieve. So I'm kind of interested, particularly Emily and Roger, you've built opt-out tools so they can be done, but I think it's fair to say it's difficult and there are regulatory hurdles to hurdle and kind of risks both to providers and potentially to employers that may make it harder for adoption of those. So firstly, can you talk a little bit more about those barriers, help people to understand kind of why is it difficult to do an opt-out model? And then I'd love to understand your perspectives, and perhaps Peter's as well, on would enabling legislation make a difference? So if there was a bill which simply said, for the avoidance of doubt, it is legal for you as an employer to enrol your workers automatically into an emergency savings tool, would that help to achieve the kind of scale that we're talking about? So maybe Emily and then Roger.
Yeah, great question, very long. I'll see if I can, see if I can hold all the thread together. Mariel, we should work together in the US, though. We operate there too. So, right. Would it make it? What would need to happen? What are the difficulties, and what would make a difference? So one of the big difficulties is when you open an account for somebody, you need to know who your customer is, and that's not really about knowing who they are. That's about knowing the source of funds. That's kind of anti-money laundering legislation, which is very important, and we should respect that. But you need to sort of be a little bit pragmatic here and say, when you are talking about an employee of an employer who's been onboarded as an employee, they've done all those various checks, and the source of funds is the employer, you know exactly where that money is coming from. Can we not just be a bit more pragmatic about that additional step? Because we know that when we put that barrier in place, it more than halves participation. So we've seen that by running some tests on our own data, we're actually beginning to introduce that additional complexity, even if it's very, very smooth, just that thing people have to do is really complicated. The other thing from a regulation point of view is maybe specific to us, but we've built really quickly on e-money rails, and we've used e-money because that was how our sort of core product was built initially. And then we've gone, great, we can repurpose this for savings. Now, you're actually not supposed to use e-money for savings. Technically, it's designated as a spending account, not a savings account. Hence why we call it our build product. You're building financial resilience. And it feels like regulation hasn't kept up with technology there, where there's a great piece of technology that's actually enabling this incredible behavior change. It's enabling this incredible trial. And we're kind of dancing in some gray space by calling it something else. It would be much easier if we could just say what it was, rather than saying it's a thing that looks like this, and you build resilience, and it's for a rainy day. And here's how you use it. And to be clear, in our user base, our members are using it for spending. Since launch, we've sort of deposited 50 million, and about 5 million is sitting in accounts. So the vast majority is spent, and it is used for income smoothing. So kind of enabling an existing technology to be used for something new would be a really important and useful change from a kind of a fintech innovation point of view. And then a little bit of pragmatism around what does it actually take to open and operate an account on behalf of somebody when you're already meeting the spirit of kind of anti-money laundering, when you already understand the source of funds, you already have sufficient checks. As I said earlier, we process £10 billion of pay every year on behalf of employers. You better be sure we know where that money's coming from, and that they're good for it. So those are sort of two things that I think are important to address. The kind of final piece of your question is, would allowing be helpful? Yeah, it would be helpful for us. It would be helpful for us in helping employers understand the things they worry about, like if I did this, what would be the considerations for national minimum wage compliance? And we kind of say, well, in our particular model, there aren't any because of the way funds flow. So you're not making a deduction as an employer. We are as a fintech that somebody has signed up with. There's a lot of nuance there, and those are challenging conversations. So we would find it easier to scale if some of those things were solved. I don't think that solves the bigger question of how do you get more people to do this. And I think the broader point is you need a sort of an infrastructure and a common standard to make this easy across employers. Otherwise, you are talking about, as Pete says, like multiple payroll integrations, multiple this, multiple that, and it can be done, but it's hard.
I think a shorter answer from me, because from a provider point of view, we found it really, really simple to do this. And that was partly because of the support that Nest Insight gave us. But I think the only thing we really had to look at was employees in the opt-out trial weren't joining through our normal website process. We were having to manually join them. So we were carrying out some of the identity checks which were required to do by the regulators manually. But actually we found that not to be a huge problem. So yes, there was an increased administration burden on TransSave, but given that the employer numbers shot up through the roof, it was a pretty small price to pay. I think in terms of what your comments about enabling employers, that's incredibly important, because I think the barrier here is, for us, is not on the provider side, it's on the employer side, because it is that extra layer of complexity they've got to deal with. So whatever can be put in place to alleviate those concerns is really, really important.
And Mara or Pete, anything to add on that topic, or I'll...
Well, I think the statutory nature of it's important, but I think also making it very, very specific at quite a granular level. We've got massive ecosystems here across the payroll industry, flex benefits, pension providers, and of course HMRC, where a lot of data flows back and forward. And as we heard earlier, we don't want lots and lots of niche propositions being built. That ecosystem will just fall over. It needs to be a very precise ecosystem, and that's why it needs to be on a statutory basis.
Nothing to add. Okay, I have millions more questions, but I'm not going to keep asking them. I'm going to throw it open to the floor. So any questions in the room, or alternatively, so I think Heather in the middle here, and then two gentlemen over on the back right.
Hi, Heather Kappes from the LSE. I guess it's too early to expect data on this, but I wonder what you think we're going to see in terms of retention rates and employee turnover. And I guess on the one hand, it might be really persuasive for employers to say, when we offer this benefit, people stay longer. But I think on the other side, one of the arguments in the U.S. for like improving government-provided health care, right, is that when we put all of this onto the employer, people sometimes stay in jobs when they shouldn't stay simply because they don't want to give up this benefit. So I'm curious about what you think will happen.
I can respond to that initially. So this is not specific to savings. This is kind of within the broader financial well-being toolkit. We see an increase in retention of around 16%. And we see an increase in things like shift fill, so people are more willing to work more shifts of around 11%. And sometimes the cause of that isn't very obvious. So if somebody is running out of money and they can't get to work because they can't put fuel in their car, enabling them to do that actually drives additional work. So there's really strong operational benefits for employers. One of the challenges is that, again, the part of the organization who's looking at this or who's buying the service or implementing this is often in reward and benefit, and it's not necessarily the same part of the organization who's measuring these outputs. So there's a disconnect between what you're doing and the value that you're achieving for an employer and kind of where they actually see and feel that value.
Thank you. Emily?
Yeah, sure. We do research amongst employers in terms of what their workers value. And pension is still coming out as the most valued #1 employee benefit, behind salary, but the pension is the #1 employee benefit. But I don't think it's whether it's on a statutory basis or auto-enrolment that's making the difference. The thing that makes a difference is the generosity of the employer contribution. If you're saying to someone that I'm going to give you 15% as an employer contribution, that might make your workers a bit stickier, as opposed to employers just doing 3% as the statutory minimums.
I think I would add to that, though, that again, in the population we see where people are typically earning less than the national median wage, they're on hourly pay, they're often in roles where they don't get a lot of additional benefit beyond statutory, so they don't even get beyond statutory sick pay. So I think where you see that in a particular population, that may not flow through or hold true across kind of low to middle income workers.
And in the U.S., so I can't say much about the retention piece, but there's a lot of discussion also around portable benefits, right? So not having benefits tied directly to an employer. And one of the provisions actually of Secure 2.0, the legislation in the US that just passed, was to actually make it easier to transfer your retirement sort of more smoothly from one employer to another if you moved. And so I think that also is potentially laying the pipes for the emergency savings component to also be able to smoothly transfer between employers.
Yeah, I'm just going to make a comment based on what we're hearing, because it's just something I hadn't kind of really thought that much about before, which is that it does seem to me, to your point, Pete, that what's already out there for employers today on emergency savings in the UK is much more disparate than was the case for retirement solutions prior to the advent of mandatory auto-enrolment for retirement. And so I guess there is a question about kind of were we to end up with a mandate, how quickly could the supply side and the ecosystem you're describing react to that in order to build a scalable solution? So that's just my wheels turning as we have the discussion, but it's been really interesting insight. So I think I'm going to go across the back. So there was 1 and then 2 and then 3 at the back in the centre there. So yes.
Ian Mulhern from the Resolution Foundation. Thanks to the panel for some really interesting contributions. I guess the vision being painted here is it feels a bit like the Singapore Provident Fund, coming out from a sort of mandatory perspective, but this being much more the sort of opt-out version of that, which also throws up in my mind, following on from the discussion we've just been having, about what the state's role in this is beyond mandating employers to opt people in as the default. Should the state go further and use its tax system essentially to pipe the money through? Admittedly, that's going to have implications for the business models of many of the panelists, or even if it sort of has a private sort of back end, as it were, the investment is done. Or is there no role for the state here and we should just leave it to the market, in which case do we run into this kind of fragmentation problem and a lot of transaction costs and frictions and stuff that's essentially not very good for employers or employees, really. So be really keen to hear the panel's views on that.
Okay, who wants to have a first go at what's the appropriate role of the state in this space?
It's a really good question, and you've kind of raised pros and cons around involvement kind of across the spectrum. I think I don't have an answer for you. I don't know what the right outcome is, but I think there is a role for the state, whether it's at least sort of clearing the path from a regulatory point of view to make this much more seamless and take some of that friction and some of those transaction costs out of it would be a first step. Do we want to go all the way to changing the taxation system? I'm not qualified enough to answer on that. I'll go back to the panel on that.
Well, I can see the state, I won't say interfering, but contributing in lots of ways that they've done in the past. You know, they can create products, if you like. You know, the government back in '88 created the personal pension, the pension you can take from job to job, and then we in the industry created the group personal pension, the pension you leave behind when you move jobs, and now we've got a smallpox problem. But I think the governments on the right of centre tend to like to create market forces so that the market behaves in a way that they think will create good outcomes, and then leave it to the market. And governments on the left of centre could be more interventionist with things like price gaps and stating how they want things to operate. And we may see a change of government in a couple of years, so that dynamic might change. But I think they can create frameworks. There's obviously the tax system, so they could incentivise different behaviours, maybe change the tax treatments from where they are now to something that might create different outcomes. And one thing that we see at the moment is the government wanting to, mandate, well, not mandate, but encourage UK pension assets to be invested in certain ways which they think would be good for the economy and society. And that may be welcomed by some stakeholders and less welcomed by other stakeholders. But I think a lot of it comes down to the politics, the left versus the right, and who's in power. So
now feels like a good moment to plug that towards the end of the day there's going to be a Chatham House session, so anyone who's feeling a little bit wary about getting too heavily into their views on the role of the state, but may have an opportunity to do that later in a less public forum. Any other responses to that question? Or no? Okay, so I think the next question was just there, and then the lady in the middle after.
Thank you. Andrew Gore from the Building Societies Association. I think what we've been hearing today is that employees need a nudge, but employers need a shove to get involved in this. And I just wondered if that does happen and we have this kind of big bang, who would be expected to hold those deposits and manage that liquidity? Kind of picking up on what you were talking about, Will. When we start that, is it the banking sector? Is it the government through NS&I? Is it Nest? Who do you think would actually manage that?
So I'm really glad you asked that, because that was one of my questions, and I'm really fascinated in people's views on the answer, not least given Joe's comment earlier that obviously kind of in isolation, fee-free, small dollar savings accounts are not the sort of, not the favourite product of financial services providers necessarily without some form of kind of cross-subsidy. So I mean, who wants to have a crack first?
So certainly in our pilot it was easier. It was a credit union. They hold the deposits. They had lots of reasons why they were comfortable holding small dollar deposits. But I think that's actually one of the reasons why it's really important to continue to follow up the thread of, if emergency savings is tacked on with long-term savings, does it not only help people build emergency savings, does it actually also just increase the universe of people participating, meaning fewer people opting out of retirement savings to begin with? Because then all of a sudden it can become a compelling reason for for larger financial institutions to sort of agree to these products, because now it actually is making a difference in their total assets under management, et cetera, et cetera. So I think that that's actually a really important component that we need to continue to track as more of these roll out. Is it not just helping people build emergency savings, but is it actually increasing the total number of people even putting their money into the pension system?
Yeah, I think small deposits may not be attractive to the banking sector, but they're really attractive to the credit union sector. That's our business model. And once those people are saving with us, we're able to offer them affordable credit. We charge interest on those loans, and that gives us a form of income. So that's quite self-sustaining. So, there's 250 credit unions in the UK that I think could pick up a lot of the slack here.
And I think to throw another model into the mix, you can also look at sort of tech and fintech, where you're actually not talking about small deposits, you're talking about a bare trust model, where actually somebody else holds the ledger and somebody else manages the account reconciliation. And then you've got quite big chunks of cash kind of moving back and forth. So it's not like we're expecting, you know, millions of accounts to open up each with a £40 balance, which having tried to do that at the very first day of my job at WageStream, I was surprised and shocked my hand was not bitten off by all the banks, you know, that I was approaching, going, good news, I can get you lots of small deposits. And it was a hard no from everybody.
There's another way there's lots of ways to skin a cat. Not that I want to skin any cats, but you could do this by building a cash account in a bank or a building society or a credit union, but an alternative model which we could steal from the retail pensions market would be to have a cash account within a pension. So in SIPs, there's a cash account within the pension. Now at the moment that cash account gets the same tax treatment and privileges as everything else, but you could tweak the pensions rules to say you can have a cash account for doing what we want to do here, but it doesn't get the same tax privileges as a pension. It gets the same tax privileges as a cash account. And then the pension provider just has, one single product, one set of costs, one set of charges, and you've got it all in one bucket. So there's lots of ways to design it, I think.
And just to build off of that, you know, going back to that U.S. legislation, right? One of those options in emergency savings is that actually you just allow the first $1,000 withdrawal from the actual retirement account to serve as emergency savings. Now, my hunch is that employers are like people. We like to do what's easy. That is certainly the easier option to sort of allow emergency savings than doing the whole, you know, a completely separate account next to it. We have done some initial just research where we randomized people into reading about different descriptions of this emergency savings structure within their retirement. So we had one group of people were randomized to just read a description where it was you could access the first $1,000 with no penalty for use of emergencies. Another, it said you have an account paired with your pension that is sort of connected to your pension that you could, or to your retirement account, that you could put in money and pull money out up to $1,000. So again, $1,000 is the limit in both of those, but the second one, the framing, is that they're separate account, is that they're connected but independent. And then we had a third condition where people were randomized to read a description where it was, these are completely separate accounts. They're both at your employer, but they're completely disconnected accounts. And you could also only save up to $1,000 for emergencies. Now, interestingly, what we found is that in these hypothetical scenarios, the more separate it was from the pension, the more people were willing to actually put into it, because it felt like, oh, it's another account to fill. Now, we weren't asking them to fill 5 different accounts. It was just one additional account. And we saw that there wasn't a cannibalization of the retirement amount. People said, oh, I'd put about this much in retirement. And then the more disconnected the accounts were, the more that they would put in the emergency savings separately. And then we asked about, if you had an emergency, how much would you pull out? And we also found that the more separate the account was, the more liquid that people actually did indeed perceive it to be, and more willing to use it in the case of emergencies. So I think that the easiest path forward is that it's all in the same thing. It's just $1,000 that you can access for emergencies, and it sort of functions as an emergency savings account. I think lots of employers will take that path within the US legislation. However, I think that the more that we can actually have it be indeed a separate account, the more effective it will be as actually building emergency savings and actually helping people use it for emergencies. So there's a little bit of this challenge of what's easy for the employer might not actually also be what's best for the employee.
And that insight about separate accounts was definitely pretty core, I think, to Bridget Major and David Layton's kind of thinking back when they were first kind of talking about this stuff. So that definitely chimes with what we've heard. Okay, I've got a question at the back in the middle, and then I'll go to Slido if there are questions from the virtual audience after that. So go ahead, please.
Michelle from Suez. We work with both TransSave and WageStream, obviously, and part of this trial. So my question is for Emily. So we've turned off the savings module, even though we partner with you, because we don't want to confuse the message for our employees, because we're opting them into saving with TransSave. But is there a charge? Because the employee withdrawing their cash that they've saved is completely free with TransSave. Is there a charge for employees to withdraw their cash or savings with WageStream? Because our employees who draw down on their earned wage early are charged £1.75 per withdrawal, capped at 1750. So I just wonder if it's the same for savings.
No, it's not. It's not the same for savings. Savings is completely free. So there's never a charge.
Thanks. Okay, I'm going to go to Matthew and see what we've got from the virtual audience.
Yeah, we've got quite a few questions coming in, and if the people in the invisible room at the back wouldn't mind throwing them up on the screen, people can get a bit of a view of them. But quite a lot of them, I think, have been addressed already in the last section of the Q&A, because a lot of them are about policy levers, what's the role of government, regulation, what's the role of the private sector. So I might just drill down into some of the more specific questions that haven't been addressed yet. First one touches on the discussion that's just been had, which is if we were to build this approach into pensions automatic enrolment, how would we make sure we don't exclude those who've opted out or who aren't eligible for automatic enrolment? And these may be the people who need the emergency savings most.
Okay, great question. Any immediate response from the panel?
I'll have a go. We know that auto-enrolment coverage is only about 64 or 65%, so a lot of people are excluded. Not necessarily at the top end for things like the lifetime allowance. It tends to be more people that are currently under age of 22. Hopefully that will change soon. People who earn under 10,000. People who are multi-jobbers, where they have different employments, where none of those employments individually trigger the 10,000 earnings cap, and the self-employed. So we need to get more of these people, I think, into pensions. But auto-enrolling everybody won't be right for everyone. But you could have a mechanism where, say, 1%, 2% or 4%, whatever we're talking about, is going into the short-term savings pot and tips over into the pension. But if you're not eligible for the pension, you don't have to have anything in the pension pot. You still have the same framework. You just wouldn't have the tipping mechanism, I think.
I mean, on a similar note, I suppose I would add, so I'm going to use my prerogative as the panel chair to add a view, but I think we've talked earlier about as there is pressure for minimum auto-enrolment contributions to rise, one potential attraction of incorporating an emergency savings component is that it sort of makes less binary the impact on people at the lower end of the income spectrum for whom that minimum level of auto-enrolment contribution could be too much, but if they opt out, they lose all of the entitlements that go with it. I think you could extend that logic as well to the question about the £10,000 entry threshold for auto-enrolment in the first place, right? And you could move towards a system, it would be at least theoretically possible to move towards a system where auto-enrolment for people up to a certain income level is only into the emergency savings piece, and the pensions piece kicks in at that level, which looks like it's a good tipping point, above which it's relatively less risky to be sort of confident that nudge is proportionate. Now, I mean, all of these things, Helen will remember, one of the kind of great challenges in designing pensions auto-enrolment was keeping it as simple as possible, and all of these things run the risk of adding complexity. But we also have more data now and better sophistication and all these things. So I think there is just a question about whether actually, again, it becomes an enabler that means you don't have to exclude anyone from auto-enrolment, and in the process you don't have to run the risk that you've sort of nudged some of the wrong people into illiquid retirement savings that they can't then access until they're 55. Okay.
Well, the next one is a slightly broader one, which speaks to the point you were making earlier on, Will, about the challenge of regulating for a mandate and how much consensus and time that might take. And it's a comparison to the introduction of pensions automatic enrolment. Questioner says the Turner Commission, which was the commission that looked at the pensions crisis in the UK back in the early noughties and came up with the recommendation of introducing automatic enrolment, says here that this was viewed as pivotal in developing pensions automatic enrolment. So should there be a new commission with a broader remit? And I guess the implication is to include emergency savings.
Do we need a commission?
Yeah, why not? We've been saying it all day today, right? We've been saying this should happen. There's a role. This needs to be coordinated. Of course we do.
Yeah, my view would be we definitely need a commission, because we have government departments that don't speak to each other with competing agendas. We have political parties with different views, and then we have the trade unions and the employer bodies that all need to reach a consensus, and then there's the pensions industry, and there's different factions within the pensions industry. And the only way to bring them together is through some sort of independent mechanism. And you'll struggle with that because people like government departments, I see some of them are here, but government departments, particularly the Treasury, I think, don't really like to cede control to a third party. So getting a commission or something like that will be a challenge in itself. So.
Yeah, and of course the IFS just last week, didn't they, I think, launched this programme of work which is intended to essentially be a bit of a kind of second pensions commission, albeit not established by government. So maybe part of the challenge is getting some of these questions on the agenda of that group as they think about what next for pensions policy. Okay, we are at time. So unfortunately, no more time for any questions. I'm just going to very quickly explain what's going to happen next, and then I will take the chance to thank our panel. So in a minute, we're going to have a few closing remarks from Anne Doherty from the JP Morgan Chase Foundation. And then we're going to give you a few minutes just to top up on coffee, because I suspect people might need a break and for a few minutes. And then we're going to come back and have a Chatham House session in the room. So we'll be closing down the live stream, have a Chatham House session in the room where we'll have a chance to just go back over what we've heard, get any views that people haven't yet been able to raise. And if you make it through that, then we'd love you to stay with us and join us for a drink afterwards. So please firstly thank my wonderful panel. Exit the stage.
Good afternoon, everybody. I feel rather sad that I've stopped the conversation to make just some closing remarks. Again, good afternoon. My name's Anne Doherty. I'm the chair of the JP Morgan Chase UK kind of governance committee for the foundation. Me and my colleagues, we provide hopefully guidance and support to the fabulous foundation team that are represented here today. I've been involved since 2011, so I remember our first grant in 2017 because we wanted to work with Nest Insight. Really, a lot of the words have been said already, like the innovation, the long-term thinking, being data-driven, being practical. And the work that's been done in both of these pilots for us has not only solidified the social, financial and emotional case for financial resiliency, which is what we focus on, that case for providing access to the most vulnerable and underserved communities, the lowest income cohorts, that's the focus, and how we think about that journey of building financial resiliency, again, in a very long-term way. What I'm delighted about this afternoon is that we're actually talking about the practical challenges to the execution of this, rather than continuing to talk about the business case. So, and it's like with any project that we and you all get involved with, it takes an enormous village to put this together. Sponsors who might help create the environment through which we can do some of this data-driven work, the employers that have been involved in this pilot, and again, I know they're on the list, the ITV, Timpson, Glasgow University, Yorkshire Building Society. We've talked about the impact of government. Money and Pension Service have been integral in this, of course, with the work that Nest have done. And we all know that there's more to do, right? We all know that this is the start of a conversation. And again, I was involved in the auto-enrollment program many, many years ago, and have seen how that started from a room a bit like this with a series of conversations and where we got to and where we are. And of course, with all of these things, they're very long term. There's constant innovation. It doesn't always happen at once, but for the benefit of our employees, of the lower income cohorts, that's the work that we need to continue to do. I'm going to stop talking now so that Will can get back up and we can have the conversation that we need to have. But thank you to BlackRock for hosting such a marvelous event here today, and to all of you for attending. So on behalf of JP Morgan, thank you very much, and I'm going to hand it back to Will.